for interest rates, Katie. And we've seen the 10-year Treasury rally 10% since the October 19th peak. We've seen the long bond rally almost 20%. And so I think the market is, as it always is thinking about the future, not the present. And what we've seen in 2023, it's sort of interesting, sitting here a year ago, 80% of economists thought we were going to have a recession in 23. That hasn't happened. And now only 25% of economists surveyed by Bloomberg think we're going to have a recession in 24. And inflation data has really come down towards the Fed's target. And in some cases, just on a 3-month or 6-month rolling basis, it's at the Fed's target. And I think it just sort of bodes well for providing some rationale for why bonds have rallied and why stocks have rallied.
Well, let's look ahead to the future, because it feels like any conversation we have about how many cuts we could get from the Fed has to start with why they're cutting rates. And I think it was Michael Purvis of Talbacken who told us earlier in the week that if the Fed is cutting rates 6 times next year, that's probably because there's probably a problem going on, and that would make him less bullish on equities. If we do get what the market is expecting, 6 rate cuts, is that perhaps bearish actually for risk assets?
I think it depends. I think if we see 6 rate cuts because the target inflation rate is at the 2% level, or perhaps even lower, and I know that sounds out of consensus, but we're seeing rents come down, so it's very possible that sort of shelter piece really starts to drop this year. That would justify rate cuts, particularly if economic growth decelerates, even if it remains positive. And so I think that you could have a scenario play out there where bonds rally a bit more in 2024. Equities remain positive because the economic picture remains robust. We had ISM data, sort of bouncing, particularly on the manufacturing side, bouncing along the bottom. And if you look at sort of ISM orders minus inventories, it's starting to really pick up nicely. And so it sort of augurs well for that industrial piece of the economy that hasn't really seen as many tailwinds this year performing well. I think that the scenario where bonds rally but equities do not would be a scenario where the Fed cuts, maybe 6+ times in 2024, and perhaps a few 50 basis point cuts would be involved, because we could see a recession. And maybe that recession is not shallow, maybe it's a little deeper. But we also have to remember, we've been talking about the possibility of a recession for the last 18 months, and we haven't had it. And oftentimes recessions come out of left field. And so I'm not ready to the towel on recession predictions this coming year, but we have to be careful.
Do we need to see the labor market here in the United States, Aaron, really break down to some extent to get a full-blown recession?
I think so. It's usually the last leg to break when you look at economic data through previous cycles prior to a recession. We're seeing some evidence of softening, but certainly the employment data is strong. The labor participation rate has been going up nicely and is back towards essentially where it was pre-COVID. And yes, jobless claims, and you look at the running trend line, have been elevated on the margin, but the employment data still remains relatively strong. And so I do think we would need to see that break, and we'd probably have to see something well above a 4.5% type rate for us to start thinking like that.
Aaron, it's been an interesting week for us with all these conversations, and I feel like there's a lot of different scenarios that everybody is kind of planning for in 2024 that we just don't quite know how it plays out, that kind of certainty is not quite there. Having said that, then, is there any conviction that you can put behind certain investment strategies right now? And I know we've talked a lot long-term, I get it, but right now, if you're thinking about putting new money to work, where do you put it?
Yeah, I would say that the certainty is uncertainty, and I know that's sort of trite, but we still go back to the building blocks of portfolio management, of advising our clients about their present and future needs around liquidity, and really their own personal risk tolerance, as well as their ability to financially lose capital and see their corpus contract to a certain extent. So we put all these sort of things together, and we build portfolios and wealth plans around those dynamics. And I would just say, that hasn't changed. But as it relates to specific portfolio opportunities, we continue to believe that equities remain a cornerstone of most client portfolios, particularly clients where we're really investing for 5, 10, 15, 20 plus years. And we're thinking, too, that if we're going to see rate cuts in 2024, which we do anticipate, and we see the long-term inflation expectations at about 2.2%, 10-year break evens on Bloomberg this morning, it's still providing bondholders and treasuries, and let's say the 10-year treasury, and therefore the overall ag, an opportunity to own fixed income here. The yield to maturity of the Bloomberg Aggregate Bond Index is about 4.5%. A year and a half ago, we had a 2 handle on it. And so think about that 60-40 portfolio, and you're trying to impute what future long-term return expectations are for major asset classes. You can now lift up fixed income, even after the rally we've seen since October, and use that and think about that for creating portfolios for clients in a way that you couldn't just 18 months ago.
Well, Aaron, to what extent then within that fixed income allocation, we've just had a conversation with Mona Mahajan of Edward Jones, and at the end of it, we were talking about where does investment grade fit in. We've had a lot of people come on the show talk about high yields in the sweet spot. Investment grade should be part of the narrative. For you, we were talking about tech IG or Magnificent Seven IG. What portion is IG within the wealth management planning, and where would you like to allocate that?
Manus, I think the sovereign U.S. market, the Treasury market, the agency mortgage-backed securities market remains the ballast. When the economy tanks, if the economy were to tank, equities are not going to probably hold up all that well, and those pieces will. So you always want to keep that in mind when you're thinking about the other pieces, including investment-grade corporates. Of course, they'll go down less than high yield, but you have to keep that in mind. And certainly, owning Meta equity is far different than owning Meta bonds. And so, that needs to be taken into consideration. One probably holds up extraordinarily well in a downturn in the economy, and that's their debt relative to their equity because they have so much cash flow. On the high yield side, Manus, I would just say, we have a huge sort of waterfalling of high yield debt coming due over the next 3 years. I think it's about $1.3 trillion. Most of that's in 2025 and 26. So we
can manage to push that a little bit into the longer grass. Unfortunately, the clock is ticking down on us on today's conversation, Aaron. But we hear your warning in terms of that high yield cliff. But that's not for some time. Aaron Cannon there of Clear Harbor Asset Management with his calls. Well, there you go. 6 rate cuts from Aaron. Now that is either something to quake about or not.
Yeah, it sounds like he's not necessarily quaking, but a really interesting conversation there.
All right, watching S&P not at a record. Dow's at another new record.
We'll get there. We'll get there. Tomorrow, we have one more session to make it happen. And tomorrow, of course, we're going to talk to the CEO of Carnival.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
This is Bloomberg.
The
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Good Thursday morning from the Bloomberg Radio studio in New York City to our worldwide audience. Paul Sweeney here. I'm joined by Kaylee Lines, and we are simulcasting on Bloomberg Radio and TV today. On this Thursday morning, first half hour of trading, equities are slightly higher this morning. Yields a little bit higher. 10-year Treasury yielding about 3.82% on the commodities front. WTI crude oil's lower, just above $73 a barrel. Gold a little bit lower. Let's call it $2,075 an ounce, and Bitcoin a little bit lower this morning at about $42,600 per token. Coming up, we're going to chat with Bloomberg News Editor-in-Chief Emeritus Matt Winkler on America's top stock picker. Plus, we're going to get the latest reporting on the Middle East. We have some economic data coming out here, Kaylee, on the housing market. Pending home sales on a month-to-month basis were flat. The consensus was for a gain of 0.9%. Still better than last month, which was a negative 1.5%, and so on an annualized basis, negative 5.1% pending home sales versus last period, which was a revised negative 6.3%. Let's break that down a little bit. Simone Foxman joins us here in our studio, Bloomberg News. Simone, the housing market, nobody's selling their home, so I'm not sure what's happening out there because, you know, why get out of a 3 or 4% mortgage rate and then have to go into something with a 6 handle?
That's been the that's been the story of all of this year, and that's been why some of the home builders have done so well, why they're near record levels in many of those stocks. But, you know, you look at this data coming out this morning, pending home sales are seen as, 2 months ahead or so of existing home sales. So it is sort of surprising here that we're not seeing an increase in our month-on-month pending home sales, considering what's happened to mortgage rates over the past couple weeks. They hit a high, and now they're back down in late October, and now they're back down under 7%. 6.67% was the Freddie Mac 30-year mortgage rate. That's the lowest since May 25th. But of course, as you mentioned, Paul, it's been an inventory issue. That's why we've seen U.S. new home sales decline. And what's clear is, that is still the case. When you look at pending home sales, there just isn't enough aren't enough homes that people can sell or buy.
Well, and I wonder how much of it too, Simone, is this idea that sure, mortgage rates are lower than they were, say, a month or two ago. But if the Fed's going to be cutting rates next year, we know that rate's going to go lower. So why would we buy now? Why not just wait another, say, 6 months?
Exactly. And why, if you own an existing home, you're a current homeowner, why would you not just wait for the Fed to continue cutting? You're going to see higher prices if that is the case. I think that's the overall theme here. But, again, that's why people are buying these new homes. And, we could see a run up in new home sales sooner than the existing home sales because D.R. Horton, Lennar are offering these mortgage buy downs. And I should point out that both those names up 70.7% this year, 65%. And you look at even luxury builders like Toll Brothers up over 100%, Pulte Group also up over 100%, all of those names trading near records.
Well, I don't know about the other folks in the, baby boomer group or whomever. I sold all my homes plural over the last several years. So if anybody needed inventory, I did my part. But that's really that's the issue. I mean, even in my neighborhoods today, something goes on the market, and boy, it is snatched up immediately,
instantly,
assuming it's reasonably priced. There's a couple homes that have been on the market for over a year, and you look at the price, and you're just like, what are you thinking? I mean, even though in this crazy market, but I think if you price it, I think even reasonably for this market, which is a super hot market, it'll move. But again, if you need a mortgage to get into your next home, not so much incentive.
I should point out, and I've been looking through the data since this number came out, there's a pretty distinct variation. We've seen this for the last couple of months, pretty distinct variation when you look at a regional level. So, for example, the South, the index level that the National Association of Realtors is citing is a lot higher at about over 80, whereas you're looking at the West, and you're seeing a level of 54, just as an indicator of the overall pending home sales and the number of contracts that are being signed. And when you kind of look at activity, even these pending home sales, you look at the South actually dropping here, but the West sort of seeing some recovery in some of these other regions, just seeing a little bit touch more recovery, even though they're the weaker markets.
All right, Simone Foxman from Bloomberg, thank you so much for joining us. Of course, a lot of what happens in the housing market and mortgage rates is going to be dependent on what the Federal Reserve decides to do next year. So let's get more on the outlook for 2024. Joining us now, I'm pleased to say, is Kathy Entwistle. She is Morgan Stanley Managing Director. So, Kathy, we've clearly seen a massive run-up in equities, a rally in the bond market as well, with yields coming lower in anticipation of the Fed potentially cutting big next year. Do you think the market is ahead of itself, or is it right on?
Well, I think that there is a lot of anticipation with these Fed rate cuts. But what I want to tell everybody first is we've got to look at 2023 and finish up strong before we enter into 2024. There's just a few trading hours left in the calendar year. And if you haven't cleaned up your portfolio yet, it's not too late. I want clients to look at their portfolio and optimize their portfolio going into 24, and that includes also mitigating any taxes with tax harvesting. So I think from that standpoint, take care of your portfolio for 2023, clean your house up, take care of tax impact, and then you'll be ready to move on to 2024, and we can talk about that as well now.
All right, so Kathy, again, I kind of feel like this market is set up for a good 2024. I said that back in October, and then, boy, it seems like we had the 2024 performance just in the last couple of months of the year. So how do you kind of position this market and the opportunities for 2024, given the big fourth quarter we had here in 23?
Absolutely. I've heard a lot of talk this morning about different types of asset classes. Cash was a big topic. I want to say, first of all, with cash, yes, there's a lot of cash on the sidelines. A lot of people are parked in that 5% savings rate or thereabouts. And if the Fed does indeed start cutting rates, we're going to see those rates go down too. So the easiest and quickest thing to look at is your cash. If that is long-term money, start thinking about locking in longer-term fixed income rates for the fixed income side of your portfolio. Start thinking about, is it the right time to start legging into the market? But don't forget, you need your emergency fund. And I think that's something that a lot of people didn't have years ago. But now we've had so many different things come up in this world. We need to have that cash on the sidelines. So just the cash that you need in your emergency fund, leave in those shorter term liquid type investments, and know that you're not going to get those higher rates for the longer term, but you do have the cash there to give you confidence if something goes wrong. In terms of the rest of the market, we want you to, yes, Magnificent Seven did great last year. It really propelled the market up. But there's 493 other stocks in this market, in the S&P side of the market, that are valued lower, in terms of valuations than those companies. So we're looking for companies with strong balance sheets, healthy cash flows, and attractive valuations. And we're also looking at companies in the mid-size, small-size international markets, and still sticking a little bit with the defensives. So you want the equities, you want the cash, and you want the fixed income. I work with individual investors, so we have a long-term view, and we also want to remember that even though every day we wake up to headline news that is not just new, but it's also big, we have to focus on the fundamentals and stay the course to keep our portfolio working for us in the long term.
Well, when we think about those fundamentals and what the economy is going to look like, when you say that you do want to have some more defensives, you don't expect that tech necessarily is going to be able to outperform. Maybe there'll be more breadth in that market or in these markets. What kind of landing are you assuming that we have, Kathy, when you're making these portfolio allocation decisions?
Well, a few things I think about. In the short term, I don't want to forget that January is typically a good month in an election year, and we do have an election year coming up next year. But we also have some headwinds, like we have some issues. It is an election year. We do have regulatory issues coming out. We do have a big Fed balance sheet. There can be discussions on tax rates. So we want to think about, for high net worth clients that pay a lot of taxes, in your taxable accounts, we want municipal bonds. That tax-free income is going to be more valuable if tax rates do go up. We certainly like corporates in retirement accounts where the tax is not an issue. I did hear a little bit about high yields earlier on, and I do like to avoid high yields, especially in difficult economic environments, because typically the companies with the highest rates on their bonds are the ones in the most trouble, so most likely to default. So I like to stay away from the high yields at this point as well.
That's kind of where I wanted to go, Kathy. In the fixed income space, 2022 was just a disaster for everybody. There was no place to hide, and that really called into question the 60-40 portfolio. But I guess the bonds have bounced back here in 23. I'm seeing kind of mid-single-digit returns. So I'm just wondering, how much risk do I take in my bond portfolio in 2024? Again, you were just mentioning high yield, but high yield was by far the best performing fixed income asset in 2023.
Well, I'm glad you asked that question, because high yield is the best performing asset class. But if they get into trouble, they can also be the ones who default. And having a background in fixed income many years ago, I am very cognizant of the fact that high yield can get into trouble in challenging economic times. So with the higher interest rates where they are, even if they're coming down, depending on when companies are rolling over their debt, they might be in for having to pay a little bit higher than they were used to, even with rates coming down somewhat. And that can cause trouble for their balance sheets and their overall, financial health outlook.
Well, when we think about if rates are going to come down, I wonder how much of what we have seen in the markets, the idea that we've seen a pretty massive rally, as Paul was talking about, the NASDAQ 100 is up 55%. We're going to see probably the best year since 1999. And as a result, financial conditions are looser than they were. And I just wonder if this market could potentially become self-defeating because it keeps conditions too easy than the Fed needs to actually finish the job.
Yeah, I think too, a lot of times when we think about the markets, and especially the stock market, we think about perception and expectations. And a lot of times you have to get ahead of the expectations of what's coming, because that's when the market moves really happen. So this big market move that we've had in this last quarter has definitely been attributed to, as Paul said, the Fed coming out and thinking about, Fed rate cuts. And that would drive a market higher. I do think a lot of that is baked in. But also a lot of the companies that have done well are just, a very limited amount of companies. So there's still opportunities. You just have to be, a little bit more thoughtful and dig a little bit more deeper, and also have a longer term view when it comes to this type of market.
Hey, Kathy, just a real quick 30 seconds. If somebody, one of your clients calls up and says, I want exposure to crypto, what do you tell them?
Well, that one's a little trickier. It's definitely very tricky when you look at where those prices were just a few months ago and where they are today. But for now, I like to just say that is like your play money. It's something that you want to think about separately. I am not managing crypto for clients. I am managing assets that are, in my mind, long-term quality, translucent, or being able to see what's behind it.
Yep. All right, Kathy, thank you so much for joining us. Kathy Entwistle, Morgan Stanley Managing Director, joining us via Zoom from lovely Ridgewood, New Jersey. Big fan of Ridgewood, great town. Love Ridgewood. I kind of feel, I think it's a valid concern, Kaylee. I mean, did we take some of the 24 return opportunity and pull it forward here into the end of this fourth quarter here?
Well, we know that the market is a forward-looking mechanism, right? And so it already has anticipated all of these rate cuts to come in 2024. So then what happens when we actually get the rate cuts?
Yes.
Can it keep going?
Buy the rumor, sell the news? I don't know. We were just, Kathy from Morgan Stanley, again, not much interest in crypto, but you know who's interested in crypto? Kathy Wood, CEO of ARK Investment. We're going to have some discussion with Kathy Wood coming up in just a moment on crypto. The ARK folks have made some changes to how they invest and how they have exposure to the crypto space. So we'll get the latest there. S&P 500, that's up 0.1%. We'll take it. This is Bloomberg.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to Bloomberg Markets, live from Bloomberg's radio studio at our headquarters here in New York City. I'm Kaylee Lyons, alongside Paul Sweeney. We are simulcast on both Bloomberg Radio and Bloomberg Television in this holiday week. And Paul and I were just discussing crypto. Maybe if you're a portfolio manager or someone who advises people on how to manage their money, you won't necessarily be buying Bitcoin or a believer in crypto, but there are those out there who are, one of them being Kathy Wood of ARK Invest. And Bloomberg actually reporting today that there's been a little bit of a shakeup in terms of Kathy Wood's ETFs and its Bitcoin-related holdings. The ARK Next Generation ETF, Internet ETF, sold all of its shares of Grayscale Investment Trust and bought 4.3 million shares of the ProShares Bitcoin Strategy ETF. And very lucky for Bloomberg, Kathy Wood joined us earlier today. Here's a little bit of the conversation about the move.
We're as optimistic about Bitcoin as we ever have been. But there are a few regulatory and tax uncertainties. We had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally. And now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. but we, out of an abundance of caution, didn't want to take any risk.
And I mean, let's get a little bit specific here because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
But you've talked about January 10th, Kathy, I think in another report. Is that possible, whether it's you or somebody else, in terms of the first spot Bitcoin ETF actually getting approval?
Well, we think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try, dogged and determined. And so here we are. We think we're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us; it's others as well. We think a number of funds could be approved at the same time, and they've been asking not only one set of questions but follow-up questions. And again, that's a very good sign.
Well, speaking of engaged, oh, go ahead, please. No.
Yeah, finish. The last few questions have been very technical, and so more de rigueur, and you'd expect them to be asking these questions as we head toward an approval. Now, it's not 100% certain, and so we want to make that clear as well. This is the SEC, and we never know, what might happen along the way.
All right, that was Kathy Wood, the CEO of ARK Investments, speaking with Bloomberg earlier today. They are making some moves in the crypto space, still long crypto, still bullish on crypto, just making some changes in actually what they own and how they get exposure there. So fascinating discussion with Kathy Wood, who continues to be bullish on those disruptive technologies, including Bitcoin. Let's switch gears. Let's check in with an old friend, Matt Winkler. He is the founder of Bloomberg News way back in the day. He's currently the editor-in-chief emeritus. He's got an interesting column today talking about America's stock picker, not some hotshot hedge fund person, but a Fidelity's Adam Benjamin. Matt Winkler, thanks so much for joining us here in the studio. Tell us about Adam Benjamin at Fidelity. How does he do it?
Well, it didn't come immediately. Adam Benjamin actually has been following semiconductors all the way back to the beginning of this century. Okay. And when you think about that, that's 2 decades of experience plus. And because of that experience, and also he truly has an affection for semiconductors and what they do. And remember, we're talking about literally what he calls the brains of just about everything that you use today, whether it's electric vehicles, whether it's, as you were just talking about, artificial intelligence. All of the things that are literally in the news are derived from what semiconductors do. And what he has done this year, like he did in 21, is actually pick the best portfolio of semiconductor companies by quite a considerable margin. He beat number 2 by more than 5 percentage points. So here he is again. And he's quite optimistic, actually, about semiconductors. One of the surprises about his recent performance is that there's a common perception that semiconductors themselves can't possibly retain their value, that, you know, once they're out, they depreciate like used cars do. But that's not really true. They have actually become more valuable, and that's because of everything that we do today is really a semiconductor connection.
Well, you talked about how he beat the number 2 fund by 5.3 percentage points. Just to give everyone some skies and scope here, this is one of 391 U.S.-based mutual or exchange-traded funds investing at least $5 billion over 5 years. He produced an 80% total return in 2023. How much of that is thanks to one chip maker in particular, which is NVIDIA?
It has a lot to do with, you know, one company, but really it speaks to what I think is an often ignored reality, which is active management is still very much alive and well. And in this age where everybody goes to their favorite exchange-traded fund or mutual fund that is essentially an index-driven product, what Adam Benjamin does, like all active managers, is try to pick on a percentage basis and weighting which companies are going to perform the best. And NVIDIA is very interesting because as much as it has appreciated, we can see from data compiled by Bloomberg that it's actually an, if you will, an inexpensive stock right now. And he would actually have done better than 80% if he could hold more than what is the required, you know, amount of 25%. So, you know, that's been a favorite, and that probably will continue to be a favorite.
And what I find interesting is his actively managed mutual fund, the Fidelity, beat the VanEck Semiconductor ETF by 5 basis points. So that goes to the active versus passive discussion there.
Yeah, I mean, look, when you get to see what's going on in the world day to day, and his world is the world of semiconductors, you have the flexibility as an active manager to increase weightings, decrease weightings, and fortunately, my colleague Shin Pei, who does most of the mathematical work on this column, we can see exactly what he's been doing all through the year.
Well, it's a fascinating column. You can find it on the Bloomberg terminal and online. America's top stock picker sees the beauty in chips by our very own Matt Winkler, Bloomberg's editor-in-chief emeritus. Thank you very much for joining us, Matt. We appreciate it. Coming up, we're going to take a wider view beyond chips to the broader macroeconomy. Citigroup economist Veronica Clark is joining us in just a few minutes. This is Bloomberg.
back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
You know, Kelly, one of the amazing stories for me in 2023, but I know it's been going on for many years, is just the growth in private credit. I always say, like, if I were to come back on Wall Street as a newly minted MBA, I would seriously consider private credit, because those people are just getting amazing amounts of capital. And we had the opportunity to speak with Apollo's CEO, Mark Rowan. He gave us his thoughts on where to find alpha and the outlook for his asset class.
We've had a sea change, not just over a year, we've had it over 15 years. So much of our public markets are indexed and correlated. 80% of volume S&P 500, 60% of the market ETFs. 100% of our returns this year are from 10 stocks, which constitute 35% of the S&P, that trade at an average PE of 50. How many of us come in every day looking to buy 50 PE stocks? Not many. And I guess what I'm suggesting to you is that public markets, they're so correlated and indexed to interest rates and to money flows, that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
Is that not inherently a risk in your mind, liquidity?
Liquidity is a risk to everyone, but in different degrees. So if you are a retirement plan or a retirement system, you know your liquidity requirements for the next 10 years. So if you can get paid for illiquidity, why not get paid for illiquidity? If you're a wealthy individual, how many of them need 100% of their money on Tuesday? If they don't, they should get paid for illiquidity. And we're seeing that in the performance data. If you look at the active management has failed to beat the index 85% of the time for 20 years. And I think it's going to get harder, not easier, to beat the index. As more and more of the market is indexed, very little money is left to actually make up what needs to be done in active management.
What is the single operational distinction between Drexel, Burnham, Lambert, and your Apollo? What is the micro idea you can give us of then versus now?
I'll give you Drexel, I'll give you Lehman Brothers, I'll give you Bear Stearns, I'll give you SVB, I'll give you First Republic. The financial institutions tend to die of one of two causes, heart attack or cancer. Heart attack is funding risk. They borrow short and they lend long. Cancer is the slow addition of poor quality assets, which over time undermine the system. So you look at all of those firms, all of those had an element of both heart attack and cancer, funding risk as well as asset risk. You look at what we're doing, we are borrowed long and lent long. Everything is matched. Everything is in a fund. There is no daily liquid, quarterly liquid money at Apollo. We are ideally situated to take advantage of less liquid assets. We've structured ourselves that way. And then you look at the totality of what we do. Equity is a risk business. Equities go up and down every day. You can lose money in public equity. You can lose money in private equity. In the credit business, the vast, vast majority of what we do is private investment grade.
When I look at the risks out there and to translate it into Nassim Taleb and all the work he did in quant with Black Swan, what are the tail risks you see right now for private equity? I mean, are you hedged perfectly? Is there next to no delta where you feel so comfortable, or are there actual tail risks at Apollo?
I don't think there are tail risks, and I don't think there are tail risks in private equity. I think private equity is a risk-taking activity, but each of the companies, each of the situations is idiosyncratic onto itself. And over time, private equity has proven to be a very good asset class, recognizing that in certain markets you will lose money.
Well, that was the Apollo CEO, Mark Rowan, in conversation earlier this month with our very own Tom Keene and Jonathan Farrow, talking there about potential tail risks. And we have to think about risks that could lie ahead for the economy in 2024 or not. Of course, earlier on this year, we were talking, Paul, about the odds of a recession. Everyone thought one might be coming. And now increasingly, the conversation is one around a soft landing. So on that note, we want to bring in now Veronica Clark. She is an economist over at Citigroup. So Veronica, it feels like everybody is feeling very optimistic right now. The landing will be soft. The Fed is going to cut, not because things are going wrong, but because inflation is just doing what it needs to do. Is there too much optimism here, or do you think we're actually in the clear?
Yeah, I think the dovish shift that we've had from Fed rhetoric in the last month or so has been a big part of that, of course. But yeah, I would caution that it still looks like a real, true soft landing is not necessarily the most likely scenario. I mean, of course, a dovish shift from the Fed might be successful in, maybe delaying a recession. Maybe those risks have gone down. But I would caution that a soft landing does need to have that 2% inflation element to it. And we have had a stretch of inflation data that have been more favorable, but it doesn't necessarily look like it will stay that way.
So, I mean, that's kind of where I want to go with this inflation discussion. Quite frankly, I never knew where that 2% number comes from. What's wrong with 3%? Will the world go crazy if we kind of hovered 2.5% to 3%? Talk to us about how you think the Fed really thinks about inflation, because as you mentioned, it is coming down very significantly.
Yeah. I mean, I think ultimately the Fed probably would be okay if we got to 2.5%, something like that. But they can't say that right now, right? You have to stick to the 2% guidance. And when we look at the underlying details of the inflation data, we absolutely have had easing in goods prices. That's been a lot of the disinflation over the last year. But if we look at services, shelter and non-shelter services, that's really where inflation looks more stuck, even at 3 to 4%, which I don't think the Fed would be ultimately okay with that.
Well, you mentioned how you're seeing goods prices, those pressures easing. It seems to be more of a services scenario as well. But is there real risk that goods inflation could come back when you're looking at what's happening, say, in the Red Sea and the potential disruptions to supply chains, which very much is a good-oriented kind of inflation?
Yeah, absolutely. And we're watching those, renewed supply disruption kind of issues again, transportation costs coming up a bit. So that's definitely still a risk. And that has been, a lot of the source of disinflation over the last year, which is supply chains, we're normalizing, things were correcting, and that's why you got slower goods prices. But at that point, this is mostly over. And so you shouldn't really expect too much more disinflation there. And there are still definitely those upside risks.
And Veronica, talk to us about the labor market. Boy, it has been surprising to a lot of folks how resilient and how strong this U.S. labor market has been. The last month data saw the U.S. unemployment rate actually tick down to 3.7%. What's your read of the labor market today? How do you think the Fed views the labor market?
Yeah, no, I think people have been trying to poke holes in some of this labor market data for a while, but it really just is overwhelmingly strong, and I think that's the most important takeaway still. It is a strong labor market. We just had initial jobless claims numbers, continuing claims numbers this morning, and they're still very low. But we have seen cracks forming, I would say, especially in some of those continuing jobless claims numbers, even in some of the details of the unemployment data, people remaining unemployed for longer, longer duration unemployment has been ticking up. So there's definitely signs that maybe hiring has slowed down. But yeah, it's definitely favorable that we're not seeing the widespread layoffs yet. But if we were in a recession in 6 months or say, you would look back and look at this data and think maybe that was the early signs of it, that hiring has slowed down and unemployment is coming up some.
Well, obviously the really resilient labor market has been one of the things that has been supporting consumers, which just have continued to spend, in many ways defying expectations, even as the excess savings pile that was built up during the pandemic has been drawn down. We went over the child care cliff. Student loan payments resumed earlier this fall, and it doesn't feel like any of that is really hitting the consumer yet. Are we actually going to see a material slowdown in the engine of the U.S. economy? Because to this point, it seems like nothing phases us. People keep shopping.
Yeah, I know we had those November retail sales numbers a couple weeks ago. We'll get December holiday season spending in a couple weeks in mid-January. And those November retail sales numbers were very robust. It does seem like consumption is still pretty robust for Q4. I think until something breaks the labor market, consumption does remain pretty supported. But that's why we're really watching the labor market data most closely. If those early signs of cracks, if those really start to accelerate, that would be a game changer.
Kaylee, we talk about idiosyncratic risk. Let me tell you about the most idiosyncratic elevator system in Manhattan. Is at 388 Greenwich Street, the home of Citigroup. I worked there for 4 years. I kept getting out on the wrong floor, even after 4 years. So, Veronica, assuming you can navigate the elevators at your offices, is there a Citigroup kind of house call on recession, no recession in 2024?
Yeah, our base case is still that we could see a recession. I honestly think the Fed was seeing the same types of signs that we were. Those issues of hiring has slowed down. There's those early cracks in the labor market starting to form. Credit card and auto delinquencies, those were picking up. So I think the Fed was seeing that also and worried about the recession risks rising in 2024. It could be that the Fed was too late to this dovish pivot to prevent a recession. So we are still expecting that might happen maybe by the middle of the year. But obviously we've had this large loosening of financial conditions from the Fed since. It may well be that we delay a recession for this year. The Fed might have been dovish enough early enough to prevent it.
Well, Veronica, this comes back to the question of why it may be that the Fed is going to start cutting rates. Because if it is indeed a recession, and that's why they decide to ease policy once again in a more material way than just saying, yeah, we're going to cut rates and allowing financial conditions to get looser. If they're cutting because things have soured, how would you expect markets to react to that? Because right now it seems that this market is thinking cutting is good news and good news only.
Yeah, I mean, right now I think it kind of is because we're not seeing those clear growth risks yet. But I think the Fed was, they're hiding behind, some temporarily softer inflation data, and that's allowing them to have this dovish shift in rhetoric to start considering cuts. But I don't know if it's the inflation data that are really leading them to be cutting. I do think they were seeing maybe some signs of weakness, and maybe we do then avoid a recession for this year. But if we don't, yeah, that's a much worse scenario for markets. Yeah.
Veronica, how concerned are you as you think about the U.S. economy, which is, as we've kind of been discussing, in pretty solid shape? How concerned are you about the rest of the world, Europe, weaker than the U.S., particularly like in a stalwart economy like Germany? Asia, the China recovery and reopening hasn't been as robust as people would have liked, and they still have their issues there economically. How concerned are you about other parts of the world kind of coming in and impacting the U.S.?
Yeah, I mean, usually the effects are more the other way around. U.S. activity will have a bigger impact on the rest of the world than the rest of the world on the U.S. We are a relatively closed economy. But yeah, I mean, if the Fed is turning more dovish and that's supporting U.S. activity, that's probably having spillover benefits for the rest of the world, coming out of maybe some of this weaker episode.
I just had a viewer writing in here, a viewer/listener, because we are on both TV and radio today, so I'm not sure how this person is joining us, but wondering how you feel about productivity and the kind of figures that we're seeing, Veronica.
Yeah, productivity is a really difficult thing to measure. We had this period where productivity was weak coming out of the pandemic, and now we've had about a year of really strong measured productivity growth, and we're kind of back on the pre-pandemic trend now, because we always measure productivity as just a residual, looking at how much has been produced, GDP growth versus employment, and we're basically thinking there hasn't been a big shift in overall trends of productivity, and that means that productivity growth is still running around 1% annualized or so. It is definitely important when we're thinking about productivity and what that means for how wages will translate to inflation. Wage growth that seems stuck around 4 to 5%, and with 1% productivity growth, that's more consistent with 3 to 4% underlying inflation still.
Hey, Veronica, thank you so much. We really appreciate it. Veronica Clark, she is an economist over at that little shop you might have heard of, Citigroup, giving us her economic thoughts. They still have a recession potentially in 2024. All right, as we flip the calendar, Kaylee, to next year, boom, election year. And
Yeah, don't I know it.
You are all going to be all over that. We're going to be seeing you from Iowa, I'm sure, and some other far-flung locales. We're going to check in next hour with Henrietta Trez. She's at Veda Partners. She's a managing partner, director of economic policy. We're going to get her thoughts on politics in 2024, because if you didn't have enough cross currents to navigate for this market, now in 2024 you've got politics.
Yeah, it's going to be a doozy. Of course, you have presidential politics with a race that looks like, at least at this point, it's going to be a rematch between Trump and Biden. What does that mean for financial markets? But you also have to pay attention to Congress, Paul, because in January, when we come back, it's not just Iowa and the first real contest in the Republican primary. It's also a deadline to avoid a government shutdown.
Oh,
and to this point, they haven't proven very good at, compromising on fiscal matters over there on Capitol Hill.
Exactly. That's going to be some challenge, certainly starting in the House. But a lot of work has to get done when our good friends down in Washington get back to town and get back to work. S&P 500 up 0.2%. NASDAQ up almost 0.3%. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to Bloomberg Markets. I'm Kaylee Lyons alongside Paul Sweeney, and we are simulcast today on both Bloomberg Television and radio, live from the Bloomberg Radio studio in New York City, where I'm lucky to be with Paul today, but this is not where I usually am. Usually I'm down in Washington, where it's been a crazy 2023, but that's probably nothing compared to what 2024 is going to bring. Of course, we have a presidential contest, a primary fight that's going to start in earnest in January at the Iowa caucuses. And Congress will be returning to Washington in a couple weeks to try to sort out fiscal matters, a budget, and how to avoid a government shutdown. So we want to get more on all of this with Henrietta Trez. She is Veda Partners managing partner and director of economic policy. So Henrietta, maybe let's just begin with Congress first. How high are the odds of a government shutdown on either January 19th or February 2nd, or potentially both?
I think that we have staved off a shutdown because shutting down is actually worse than taking the votes to keep things functioning at their current levels. So I think January 19th and February 2nd are just going to roll into March and April, June and July, probably 2 to 6 times through the first half of 2024. The most important date for investors, since we've sort of bifurcated the appropriations bills and we'll only have partial shutdowns of pieces of the government, in the event that there are shutdowns. I think the most important date for investors is sort of the run up to May 1st, particularly in the defense space, because I don't think they're going to avoid the sequester early, and I don't think they're going to come up with some grand bipartisan deal, as y'all were sort of alluding to earlier. There is no bipartisanship on Capitol Hill around anything other than, hey, let's just not shut down. So I think as we get into mid-April, investors in the defense space who are looking down the barrel of a 1% spending cut for defense are probably going to get a little anxious, a lot of headline risk as they seek to avoid that at the 11th hour. So maybe keep May 1st on your radar and maybe April 15th around then for headline risk to start moving.
So is there any line drawn in the sand where something permanent has to get done, or can this can be kicked down the road throughout the year?
That's a great question. I don't think there's any scenario outside of the chance where Joe Biden is president and the Republicans control the Senate and or the House that you get any long-term deal. And the only reason that I say that is because in 2025, we have to have a massive tax bill. As you know, all the 2017 tax cuts expire, and just keeping them at their status quo just for individuals is $2.3 trillion. So you're going to have an organic situation in 25 where we have a massive bill that has to pass. And I can see a world where a Democrat in the White House and Republicans in control of Congress can create something akin to the 2014 era of Simpson-Bowles and, the grand bargain, the deficit commission, at least those conversations that could come up with something more holistic, and maybe you have a real earnest conversation about spending cuts and entitlement changes and corporate tax rate hikes. Maybe not all the individual tax rates are extended. That's your first opportunity for a long-term deal. In 2024, in a presidential election cycle, you're not going to get long-term anything. If we get 3 months at a time of functionality, I'll be impressed.
Well, and before we can even get to 2025, to your point, Henrietta, people need to last 2024, which brings me to the Mike Johnson question, of course, the relatively newly minted Speaker of the House, who has passed a continuing resolution with Democratic support, which is what got Kevin McCarthy kicked out of the job in the first place earlier this fall. So I just wonder how much longer he's really got if he's going to need to fund the government and potentially does need to kick the can, and House conservatives don't like it.
Right. And you've already seen the House conservatives say, the deal that was negotiated last May with Kevin McCarthy, A, he's not even a speaker, B, he's not even a congressman anymore. And then the next question is, how long is Johnson going to be the speaker? In D.C., if you go to meetings with staff, they'll say, is it going to be 6 months or 6 years? The verdict, the jury is very much out on that one. And it's a popular parlor game, which does not bode well. I think the honeymoon phase is over. I'm going to be really interested to see how members start reacting when they get back into town. It's impossible for about 8 to 20 members of the far right to agree to any spending level. And we're not talking about huge chunks of change right now. The difference between the far right and the moderates in the Senate, which have overwhelmingly passed all 12 appropriations bills, is like $25 billion. And we're talking about a $1.5-ish trillion package. So for the difference to be $25 billion, it's like, me asking you for $5. It should be no big deal. But they literally just don't have the votes for anything that sounds like yes. So those guys are always going to be voting no, which forces Speaker Johnson to constantly be negotiating with Democrats, which is, of course, anathema to the far right. But they are ironically the ones that are enforcing that reality on Speaker Johnson. So I hope he can make it through April. Obviously, we've seen how long a series of votes can go on the potential for another speaker. So I think that'll be really drawn out. Nobody wants to do that, but memories fade, and maybe they've forgotten how uncomfortable that was in October.
I think when Congress gets back, they kind of have to make a decision on foreign aid, Ukraine and Israel. What's the latest there?
That's a great question also. I think what we're going to see is this effort to get one big lump sum that covers all of fiscal year 2024 is probably abandoned. The most important person to watch continues to be Minority Leader Mitch McConnell, whose sway over the Republican Party has been on a decline for several years now and is now pretty much inconsequential, as you've seen from this conversation. You hear from staff across the room, and especially in Republican circles, that he has pivoted to away from making the Supreme Court and the Trump era crises something that he wants his legacy to be, to now be Ukraine. But unfortunately, he doesn't have the votes from either Trump on this issue or the far right, and the Senate Republican conference is growing their progressive wing, their sort of populist wing, if you will. So I think that makes it really hard. So to answer your question directly, instead of getting one big 106 or $110 billion package that covers Israel, Ukraine, Taiwan, and the southern border, I think what you see in the January 19th, February 2nd, March, or whatever deadlines, little baskets. $3 billion here and there, maybe the full, 12 to 15 billion for Israel and the initial package, which would be helpful to them, but something in the $5 to $8 billion range for Ukraine a couple of times in 24 makes more sense to me than one big lump sum package.
Well, Henrietta, you just mentioned in that answer both former President Trump and the Supreme Court, and we do actually have some news in that regard. Politico reporting that the Colorado Republican Party has now asked the Supreme Court of the United States to reinstate Donald Trump on Colorado's primary ballot. This, of course, is after the Colorado State Supreme Court ruled on the grounds of the 14th Amendment that Trump is ineligible to serve as president again because of his actions on January 6th, saying that he engaged in an insurrection. It seems like the prevailing thinking is that the Supreme Court is going to overturn Colorado. The former president will be back on the ballot. But does this legal challenge, do any of the many legal challenges he's facing actually make a material difference in the odds of him being the Republican nominee come this summer?
I think that it's important to look at how helpful polling data is and voter opinion now versus where it'll be at three different points this year. Right now, the R-squared value of polling data is near 0%. Why? Because there's, 11 months before the election starts to take place. And what you know from historical data is about 30% of the undecided population in America, which is most of the independents and about 14% of Democrats, people who are saying, I don't want Biden, I don't want any of these candidates, and maybe I don't want Trump. Those voters, which are going to decide the election, 30% of them make their decision by March. Another 30% make their decision by July, and the remaining portion decides in October who they're going to vote for. And that is the entire ballgame. That is the election. So if you have to think about who has momentum, number one, gas prices are coming down. They're forecast to come down further in 2024. In my neck of the woods, it's $268. So that negates that talking point. On the trial front, every single time you have a primary election, which is going to be good news for Trump and my expectation across Iowa, New Hampshire, South Carolina, and Nevada, you're going to have the negative data points of the New York civil fraud trial, the Georgia trial, all those things layered on, along with improving economic data. Y'all just had a fantastic interview with Veronica. Those economic data sets, when you're at 3.7% unemployment, job growth, wage growth, gas prices coming down. If you get food prices to come down, whose side do you want to be on? The momentum swing from a Biden candidate who's at the floor right now in his approval, or Trump, who's at the ceiling of his approval going into what is looking to me like only a bad news cycle. Right now, he has the benefit of fighting and winning against the sort of never-rans or the never-wers on the Republican side, the Nikki Haley, DeSantis, Chris Christie wing. And so he has that winner momentum. Biden is running against no one, and soon he's going to be running against Trump. And I think as soon as we get into that around March, this whole conversation will be much different.
Interesting. Boy, you are plugged in. Henrietta Trez, Veda Partners, thank you so much for joining us. I tell you, I'm just blown away every time I talk to her. She's plugged
awesome.
into all things D.C. Coming up, Andrew Brenner, Nataline Securities, head of international fixed income. He's going to join us and talk about the fixed income markets. Boy, good, strong finish in 2023. How about next year? This is Bloomberg.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Welcome back to Bloomberg Markets. Kaylee Lyons, Paul Sweeney. We are live here in our Bloomberg Radio studio. We're simulcasting on Bloomberg Radio and television. How cool is that? Looking at this markets, our second to last trading day of the year, a little bit of green on the screen. Why not? It's been that kind of quarter, that kind of year. The S&P's up about 0.2%. Same for NASDAQ here. And the Russell kind of off just a little bit. We had seen some widening out there over the last last two or 3 months. Yields pretty steady here. The 10-year Treasury, 3.8%. WTI crude oil, pretty steady too, just under $74 per barrel. Bitcoin pulling back about 2.2%, 42,400 on Bitcoin. I'll quote that for Tom Keene. Let's check in with Jess Metten. She is our Bloomberg equities reporter. She's got a lot of great stuff out. She writes all the time. This radio and TV gig is just a side hustle.
That's right. I do have a day job.
Equities team, and you guys on that team put out a lot of good stuff about what's happening in the markets. What are you looking for towards, I don't know, next year?
Well, I want to point out, though, if you look at the S&P 500 right now, trading around 47.89, so it is about 0.1% away from that record high it last reached almost 2 years ago. So January 3rd, 2022, the magic number being 47.96. 56 is the level there. So keeping a close eye on that. But if you look ahead to next year, some of these key themes being, not surprisingly, the Federal Reserve, of course, and the trajectory of their rate cycle and when potential cuts could come there. And then also, of course, big tech. We've seen this huge rebound here, and especially when you look at the NASDAQ 100 on pace for its best years since, obviously, the height of the dot-com bubble. And then, of course, you have U.S. elections next year. So that's another key theme when any traders follow the presidential election cycle. That's going to be key. And then, of course, different risks when you are looking over at Asia, whether it's the Bank of Japan still has that negative interest rate policy, but what it could mean, because you do have economists that are betting that potentially they could have their first hike in a long time in April there. And then also you do have different risks going on with Europe, especially those cyclical stocks in Europe that do have exposure toward Asia, Paul.
Well, Jess, I want to talk about your first point, which is the idea that it seems like so much of this enthusiasm in equities is driven by the expectation that the Fed's going to be cutting rates next year. That's next year, maybe end of first quarter, maybe in the second quarter. Time will tell. Maybe the market is a little bit more aggressive in that pricing than the Federal Reserve is necessarily suggesting at this point. But if we've already baked all that in, what's going to power equities higher in 2024? Are the actual cuts being delivered going to be enough?
Well, part of it is that because when you look at the market expectations here, and especially swap traders are looking at the central bank, if you are talking about the Federal Reserve cutting rates by potentially 150 basis points next year, could come as soon as the spring. But if you look at the Fed, obviously those officials have pushed back on that in their forecasts, and those latest dots don't come. And they're kind of actually trying to signal here to traders that that won't be until the second half of next year. But a big thing also is earnings expectations because of obviously the big AI theme with NVIDIA this year, and especially when you think about what was happening with the AI frenzy, especially back in May. But a lot of that support for those technology stocks actually came ahead of that, if you remember, because we did see that big bounce in January earlier this year. And a lot of that had to do with the margin and cost-cutting controls, especially when you think of stocks like Meta, right, that started with that first tranche of job cuts at the end of last year and then had a second one in the spring. So it was really a big margin story and what that means for productivity boost as well as AI. So can those, when you look at the Magnificent Seven stocks here, if you look at the Bloomberg intelligence data, which I know Paul, big fan of here, if you look at their BI dashboard, they are, and this was some data Elena Papina on our team was looking at, but if you look at the Magnificent Seven, expected to post 22% earnings growth next year. So that's actually twice the estimate if you look at the S&P 500. So there's going to be a lot of scrutiny, Kaylee, when you are looking at some of these technology names and what that means, and if they can back that up with those valuations with what it means for moving forward, especially NVIDIA.
You know, we talked to Abigail Doolittle a lot. She will talk about, you know, just the health of the market, the breadth of the market. And we saw the breadth really, I guess, improve there in the fourth quarter. I'm just looking at the S&P equal weighted index. That's up about 12% year to date, but it was only up a couple of percent through September. But it's really outperformed here in this fourth quarter. I think that's what the market observers will say is a good thing.
And also small caps.
Yep.
If you look at the Russell 2000, up more than 20% since its low in October. So usually you see those begin to take off historically in mid-December because of some of the tax loss harvesting. Some people call it the January effect when you do see that take off in small caps toward the latter end of December. But we've seen them pretty gangbusters the last 2 months here, as well as bank stocks, especially when you think about what happened back in the spring with the regional bank stresses. A lot of those more value corners of the market, in addition to small caps, have been taking off the last few weeks.
I want to return to, because my brain always does, because usually, Jess, I'm in Washington, not here with you guys in New York, this idea about political risk, because you mentioned it, we're heading into 2024, obviously a presidential election year, not to mention congressional activity and the like. How are equity markets and equity traders thinking about that at this point? When does that political risk actually hit? Is it October 2024? Is it sooner than that?
Well, I think the big thing, especially with people who follow the presidential cycle, a lot of times people will think, well, it matters who's going to take the position as the president. But what actually matters more for the broader stock market is gridlock in Congress, because if there is gridlock, that means it's going to be harder for certain policies, whether you're looking at technology regulation or things with healthcare, things like that. And Paul knows this because he's covered it for so long. But basically, if you have gridlock in Congress, it's harder for those policies, any sort of extreme policies, to be passed. So then usually stock traders are going to like that versus whether or not who's going to be in a position of power. So when you look historically, especially in the election year with seasonality in the presidential cycle, it actually really matters if a sitting president is running for re-election. So typically when that does happen, the S&P 500 going back since World War II actually averages a gain of about 13%. When you don't have a sitting president running in an election year, it's actually the opposite. The S&P 500 in that span has actually averaged a loss of around 1.5%. So when you look at historically, technically bodes well for stocks going into next year, but obviously we know things don't always happen with what history says, but that does look kind of a bullish setup for anyone that's following the seasonality cycle with the presidential cycle next year.
We've got a sitting president, check. We've got a Congress that can't agree on anything, double check.
And so there you go. There you go with the different policies and what that means. And then also typically when you have an incumbent president, and basically in an open field, like I was mentioning, averaging a loss of 1.5% next year. But also usually when you have a sitting president, they typically pass certain policies to either not on the fiscal side to try to kind of boost morale going into next year. So it'll be interesting to see how things shake up a year from now.
Yeah, absolutely. Of course, we got to finish 2023 first. We're almost there.
Almost there.
And it looks like, at least for equities, it's going to be a strong finish. Jess, you have us on record high watch, so we're watching that in the S&P 500. Jess Minton from Bloomberg News, our equities reporter, who often graces radio and television with her presence. Thank you so much. And Paul, once again today, if you look at the actual points contributors in the S&P 500, which could very well power us to just within inches of a record or perhaps to one, Apple, Microsoft, NVIDIA, AMD, Meta, they are the big contributors on the day. And we know they've been big contributors on the year as well. So we want to get more insight into the technology space now. Joining us, I'm pleased to say, is Bloomberg's Mark Bergen. So Mark, we have a lot of specific stories to discuss with you when it comes to Apple and AI, but just broadly looking at tech for 2024, what do these names need to deliver to keep this kind of optimism around them going?
Yeah, I think 2023 was certainly the year of generative AI explosion in interest, in research, in money going into startups and large companies investing in it. Maybe Apple it stands outside that, but everyone else. And 2024 in some ways will be, okay, can this actually be a commercial business? Can companies like OpenAI and its competitors, can Google turn these chatbots and AI services into something that is a lot of enterprises and big banks and hospitals and governments actually want to use and pay for? I think that's going to be really key going forward, and that'll influence, say, how much the NVIDIAs and AMDs and Intels continue to rise.
Yeah, you mentioned, ChatGPT, Microsoft. One of the big issues as we start to develop use cases, we being just the economy and society, use cases for AI is copyrights and things like that. And the New York Times was in the news yesterday, I think, with something as it relates to ChatGPT. What's going on there?
Yeah, a fairly significant move. The New York Times sued both Microsoft and OpenAI, and Microsoft is, of course, OpenAI's biggest financial backer, a very tight partnership, use a lot of OpenAI's tech in their own products. The lawsuit from the New York Times basically accuses them of just stealing millions of articles, investigative stories, everything on the New York Times website to train ChatGPT and other AI services. So this is something that this is not a new criticism. OpenAI has actually cut some licensing deals with other publishers. They were in talks with the New York Times, according to the lawsuit, as early as starting in April. It's not like they didn't come to a resolution, and the Times, in this negotiating tactic, has kind of hit them with a surprise holiday lawsuit.
Yeah, really, really fascinating. And that's not the only lawsuit that has been making news around the holidays, because, of course, on Christmas Day, it was the deadline for this patent dispute between Apple and Masimo over the blood oxygen technology in the Apple Watch, the Series 9, and some other later model Apple Watches. This idea that they violated a patent, therefore had to be banned. Yesterday, we got the news that an appeals court has essentially put that on hold. I believe Apple Watches are coming back into stores now after they'd been paused or pulled off the shelves for a few days. How does all of this move forward, Mark? What happens next in this patent battle?
So next, my understanding is January 10th is it kind of goes back to the court, the U.S. Trade Commission, to make a decision. It's something that's really unique, and there's a great story in the terminal today from Bloomberg Law. This is unusual for Apple. Like, usually a company that size, like Tim Cook could find the change in his cushions to settle for this company with this company, and he hasn't. And I think that's being interpreted by a lot of legal experts as to sort of Apple's drawing a line in the sand here and saying, listen, if you're going to come after us on copyright and patent infringement, we're not going to stand down. Right? We have enough lawyers and enough money to fight this, and it's certainly been inconvenient for them. These are just the two models of the watch. So it wasn't just all the Apple Watch. And so this is, still a small part of Apple's overall business. But it comes at the tail end of a year where it's not been great for Apple. They're in the crosshairs of a lot of the troubles around China and the increasing trade war there. Their sales around devices have started to plateau. They're seeing some growth in the services business, but that story that they're looking for of what comes next after the iPhone, one of those big devices and markets was around healthcare. And so now that this is sort of a limitation, certainly they can't actually go into healthcare because they're going to be restricted on the patent or this idea that companies want to keep going after them.
So, I'm actually surprised, just having observed Apple over the years, that they either haven't settled or engineered a workaround. I mean, is there any consensus how this might play out?
Hey, so from our reporting, and it seems like they're kind of taking a dual path here. One is to continue to fight this in the courts, and the other is to work on a software fix that will appease the regulators in the sense that to prove that this is a distinct enough technology from whatever Masimo is, a company, the medical device company. And I think that if that's the path forward, then they can kind of proceed and ignore the case. I think we can sort of interpret the fact that they haven't settled yet, and it's been this pain, and who knows how much it's hit their bottom line, but certainly around the holiday season is pretty strong for the Apple Watch sales. As an indication, this is like a legal strategy or kind of a political strategy in some ways, that they're going to demonstrate that they're willing to fight these patent cases.
A lot of big issues, as there always are in big tech, and Bloomberg's Mark Bergen is all over it. Again, I highly recommend people go onto the terminal on Bloomberg.com to check out his article today, is reporting on the New York Times suing Microsoft. I mean, who sues Microsoft? New York Times is suing Microsoft and OpenAI for copyright, because this is just going to be massive for years to come. And we saw it a little bit in Hollywood with some of the writer's strike, in particular, and to a lesser extent, the actors' strike, getting protections on their content, on their names, image, and likeness in the world of AI. So we're seeing it across the board. Coming up, Andrew Brenner, Nat Alliance Securities, head of international fixed income. He's going to join us, give us some thoughts on where we go in the world of fixed income in 2024. That's coming up. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets. Kaylee Lines here alongside Paul Sweeney from our Bloomberg radio studio here in New York. We are simulcast today on both television and radio as we are in the final days of 2023, looking ahead to 2024. And Paul, it's remarkable. If you look at the bond market and the volatility we have seen right now on the 10-year Treasury yield, we're at 381. We started the year at 387. So we are very, very close to being not very much changed on the year. And yet we have seen some pretty high highs of around 5% on the 10-year Treasury with lows around 3.3%. It's been a lot. So what is 2024 going to bring? We're going to get some insight into that now. Andrew Brenner is joining us. He is Nat Alliance Head of International Fixed Income. He is here with us, I'm pleased to say, in our radio studio. So Andrew, what are we in for in 2024? What's your base case here?
Base case is going to be a lot more volatility. You know, we predicted that the people were just not long enough in the bond market, too much money in cash, too much apathy, whatever. And we've gone from October 27th of 502 all the way down to, I think, 378 yesterday. So, I mean, we've had a lot of movement. In fact, these 2 months have been the strongest number in Bloomberg Ag, ever, 10%. And in corporates, it was even more, 11%. So I think we're in for a lot more volatility. What I would say is, I think a lot of it in the last week or so, or a lot of this month, has been window dressing. Once Powell made the determination that they're in a pivot and they're going to be easing next year, the market just took it upon themselves to build in over 6 eases, 6 cuts for 2024. And while I think that is correct, I do believe the market's going to go back a little bit, and I wouldn't be buying it here. The numbers I like are 402, which is the 200-day moving average, and maybe a little beyond that. When I look at next week, you're going to have 50 billion of corporate issuance. You're going to have the unemployment number on Friday, which is going to be strong. You've got the CPI number the following week, and we expect Fed governors, not Powell, to push back on all these rate cuts. So, there's still a lot of people out there that believe the Fed will only do 3. We look at what the Fed says and we totally ignore it. But nonetheless, and there was an article in the FT today saying central banks don't know how to predict. And that is certainly true. So we still think it's 6, but I wouldn't be buying it just now. I would probably wait until we get the next Fed meeting around January 31st.
Irving Trust? Nice. That is old school.
Well, you've looked back. It was nice to be at 1 Wall Street.
Yeah.
But you're going back a long time ago. Beautiful building, I'll say that.
Serious Irving Trust. That's going old school for Andrew. So, Andrew, I look at my IN function, Bloomberg Index Browser, and I was surprised. Well, the good news is it's all green for fixed income in 2023 versus the terrible 2022 that there's no place to hide in 2022.
Well, I understand that. Up until about 2.5 months ago, it was still red.
That's my point. And so I'm surprised to see corporate high yield up 13.5%. Everybody's been talking about a recession for 18 months. I'm surprised the high yield did so well. What do you think's driving that market?
Well, first of all, Paul, I was one of the first to consistently say no recession. I believe that when Bloomberg ran something towards the end of last year, everyone predicted a recession in 2023. I didn't see it being close, and I still don't. The economy's strong. So what has happened is high yield is very different than high yield of the past. It's more of a double B type entity, and a lot of these companies are stronger. So it's really, it's come back very strongly. The economy, again, it's all about the economy. The economy is strong enough that these companies are still doing well. And even though there's a big wall of refinancing going into 2025, I think high yield is still okay. Having said that, just as I said about 10 years, I wouldn't be buying IG with CDX at 56. I wouldn't be buying high yield with CDX at wherever it is, 355, 360. I think those are too tight of levels, but I would look to enter those markets after a backup.
Well, it's interesting, Andrew, to hear you talk about how you haven't seen a recession for some time. You still don't see a recession, yet you do think the Fed could be cutting 6 times next year. And I feel like this is a prevailing view now, the idea that we're going to get really aggressive cuts as the economy holds in there. Why do you need to cut so much if the landing is soft and things are good?
I'll tell you why. I love this question, because inflation has come down dramatically. There's absolutely no reason for the Fed to be at 5.5%. Fed funds when you have PCE running at 2% or 1.9 over the last 6 months. The real rates are way too high. Powell hinted at it and started to talk about it more, and there are others that have talked about it. When you look at real rates, there's no reason the Fed funds rate can't be 4% today, and still be restrictive for everything. So the Fed has gone way too far, way too fast, and they're lucky that there was only a break back in March, and nothing really has broken since then. So I think the Fed should get ahead of the curve while they can and bring rates down to 4%. We're not trying to stall the economy. I mean, unemployment, it still continues to be at historically strong employment seems to be at strong levels, unemployment at very low levels. So I think the economy's fine, which is why I don't see a recession, but inflation has come down dramatically, and that's what the Fed has been fighting, and they've won that battle.
So I'm looking at the mortgage market. Kaylee's looking at the mortgage market. We're seeing mortgage rates come down. What is a declining rate environment? How do mortgage-backed securities perform in that kind of market?
You've had mortgage rates go from roughly about 8 1/8 to probably around 6 5/8, 6 3/4 as we're sitting here
old
today.
School, we're going 8.
I was going to say an 8.
Nice. Hey, that's how we made a living back in the day, off the spread.
Right. You know, mortgage spreads have come down dramatically. I think they've been following corporates. We still like mortgages for 2024. But, you know, I mean, mortgages had gotten, you know, way at very low dollar prices. And when you're buying a mortgage at a $65, $70 price or 75 or something along those lines, I think they make good sense. The spreads are still there. They're AAA products. You know, the housing market really hasn't collapsed. In fact, the housing market's been very strong. And if you're out there looking at homes, which is what the implication is from what you just said, then you're going to find prices are very steep. And, you know, and very strong. And now mortgage rates coming down. Now, that part hasn't factored in. I think today's housing numbers were weak, and it's all a lagging thing. But housing will continue to do okay, and there's a lot of new houses being built throughout the country. So it's picked up because of the lower mortgage rates, and I think that will continue.
Okay, so jury's still out as to whether or not I'm going to be able to buy a house in the immediate and or short-term future. Andrew, what are you buying right now? I know you said you like, what, 402 on treasuries? Where else are you finding good value in fixed income right now?
The only thing that makes sense right now are 3-month bills at around 535, 540. I'd rather take the duration risk and wait for a better entry point. You know, granted, there's $6.1 trillion in money markets, and that will be forced into the market sometime this year. We're predicting 10 years to get to, you just said it before, 330. That's, you know, that's kind of what the lows are. So that's what we have targeted. So you've got another 50 basis points to get to. I just feel it's going to back up. It's moved too far, too fast, and there's just too much belief now that the Fed is absolutely going to ease in March, May, and in every meeting throughout the rest of the year. I just think that they're going to push back on that. I do think eventually it will happen, but I just think push back, and I think there'll be better entry points.
30 seconds, municipal bond market, my favorite.
You know, that's not my expertise. The municipal bond market is very interesting. It's been very quiet. You've had very little issuance of new issue municipals towards the end of the year. So municipals are a little bit tight, but according to my desk, they expect a big uptick in municipal issuance. But you know what really bothers me, Paul, is the fact that Citi, who I think is one of the best banks in the world, I really do. I mean, they've been great. I get all their commentary. I highly advise you to read the Citi stuff. It's great.
Yep.
I can't believe they're getting out of the muni market. I mean, they were the stalwarts.
They were getting out of distressed debt as well. Andrew Brenner, thank you so much for joining us. Andrew Brenner is the international head of fixed income there at Nat Alliance Securities. A great voice on these markets with the fixed income space. Again, some positive returns in fixed income in 2023, and that you know, after 2022, which was historically bad for fixed income. Coming up, Ilana Weinstein on the IDW Group on how hedge funds performed in 2023 and what to look for from our hedge fund buddies in 2024. S&P 500, I'm calling it unched on the day, another term I like that Lisa Bromwich does not. Dow's up 10%, NASDAQ's up about 0.1%. I'm sorry, same for the Dow at 0.1%. NASDAQ also kind of flattish on the day, so a quiet day.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Hedge funds, you know them, you love them. How was performance in 2023? What to look for in 2024? Ilana Weinstein joins us. She's the founder and CEO of the IDW Group. And Bloomberg Shonali Bassik, who covers all of Wall Street, joins us. How cool is that? Shonali, let's talk some hedge funds.
I've been waiting to have this conversation all week because what a weird year, Paul, in hedge funds. And Ilana is so plugged into this universe. Let's talk about performance first, though, because what's stunning is you've seen this massive melt up in markets, and the hedge funds, by and large, across the industry really have not kept up. Bloomberg's All Hedge Index is only up about 4.8% through the year so far, and the multi-strats, which are supposed to be the kings of the castle here, are only up less than 3% on the year. Ilana, what's going on?
Okay, so let me unpack those numbers. First off, the hedge fund index, I think, is a blend of everything. So we need to kind of go strategy by strategy to really pull out what the themes are. Long short equities, which had a really tough 21 and 22, finally, Shonali, had performance. I am pleased to sit here and say something positive, which I have not been able to do for the last couple of years. Those funds, which are a big percentage of the hedge fund universe, the directional, concentrated, Tiger Cubs, and similar, are up as much as 20%, 30%, even 40%. The issue there, which is really important, is even though they're up that much, they still have, for the most part, an enormous high watermark to have to get out of. And let's just say it's a fund that's up 35% this year, okay? You may think, and they were down about 50% between 21 and 22, you may think, okay, year one this year, up 35, they can get out of that remaining 15 or 20 next year, and then it's smooth sailing. But the reality is their AUM maybe was 13 billion at the beginning of 21. It's 6.5 billion now. So that 35% is on a much smaller base of capital, and it's actually as a result. So there are very much fewer dollars made than it would have been had they made that money back up before they had the losses. And as a result, there's really another 65% to go. So that's a huge headwind for that strategy.
How much more excitement is there around the industry, especially because many of them have not met the market performance still? And so even if they're up, they have two issues here, to your point, the high water mark, and the issue is you could just invest in the S&P or the NASDAQ or even the SOX up 65% this year. How does that set them up into appetite, investor appetite for new hedge fund allocations next year?
Well, let me also touch on the multi-managers, which you cited. It is true that blended, it's not a great result, but unpacking that, there's a lot of dispersion in that result. If you look at the more established multi-managers that have been around a while and have built a mousetrap that is very difficult to compete with, funds like Citadel leading the pack up 15%, which is a very different number than what you cited, or Millennium, 0.72, up double digits, and then the rest are struggling. And that has a lot to do, so to answer your question, LP appetite, The reality is the reason the other multi-managers grew so quickly is because the more established players were either closed or very deliberate about how they grew. And if you can't allocate to the more established guys, or at least not at the level you'd like, then you end up pouring money into all these other funds that grew in the last 2 years hand over fist. And when I say quickly, I mean between 3 and 8x. Think about that. Over a 24 to 36 month period, it is very difficult to deploy that kind of capital growth and hire a winning team in order to do that. Talent is really difficult to hire and attract. No one knows that better than myself and my team. And so you can't get from 1 billion to 8 billion, hire 150 PMs, and expect a great result. There's a lot more that goes into this.
Okay, well, let's talk about talent, because I feel like it was, pandemic era where all we were talking about was the competition to talent and compensation wars, who can offer the best starting salaries and the biggest bonuses. We know that it has been a more difficult year in terms of actually people getting paid, and we're probably finding that out here at the tail end of the year. So what is your view here on compensation and how these firms are making themselves attractive?
I think compensation kind of falls into one of two buckets. It's either formulaic, and for example, if you're at a multi-manager with a pass-through, you know exactly what you're getting paid. There's no mystery there. Or you're at a fund, which is like a single manager, where if you're a senior person, you have points in the fund, and then there's maybe a jump ball with respect to being able to reward you on top of that. But to the extent it's a fund that has a high watermark, there hasn't been a performance fee for example, the long-short equity managers in 21 for the most part. There wasn't one in 22, and even though they put up this incredible performance in 23, they don't have a performance fee with which to pay those people. And so to answer your question, I think there's going to be a lot more frustration this year than there even has been the last couple of years. Those people are going to get paid more because the founder is going to feel he or she needs to reach more deeply into the management fee to pay them. But when you're someone who's put up hundreds of millions of dollars, even billions of dollars, the dispersion between what you're actually going to get paid this year and what you've produced is going to be very frustrating versus in previous years where there wasn't performance for the fund. I didn't put up performance as an individual, so whatever I get paid, I'm kind of okay with, because that's the ethos of this industry. It's pay for performance. Now I've put up tremendous performance, and my founder isn't really paying me something that feels in any way proportionate to what I should get paid. And I want to also highlight, as much as some of these funds lost a significant amount of AUM, we're talking about falls from grace of 30 billion to 20 billion, or in the case of Tiger Global, 100 billion to 55 billion. But think about the management fee on 55 billion. That's still $1 billion of fees. Or on 20 billion, that's 400 million of fees. So, and these teams are relatively lean, particularly at senior levels, and everyone knows that. So it's early still vis-a-vis comp, but what we're hearing, even though the number is better, is an increased level of frustration, and I think there's going to be more vulnerability at these funds as a result.
When I left the street in the mid-2000s, I studied long and hard about whether to transition to the hedge fund business. And what I concluded then was that long-short equity, no alpha left, done. Game had been played out. So I came to Bloomberg. So my question is...
And how lucky we are, Paul.
And I was absolutely correct. The numbers bear that out. My question is, if I'm a really good trader, I don't know, bonds, currency, something at Morgan Stanley or Goldman Sachs, back in the day, I could just leave and go raise a couple $1 billion, and then boom, that was my path. Does that still exist, or does a lot of the new money coming into hedge funds go to the 0.72s and the Citadels?
Well, as I said earlier, some of those established managers are closed or very carefully accepting new capital. Believe me, there's a line around the block to allocate to those. But two things. One, the days of leaving the sell side to go start a hedge fund, I think you'd have to be completely nuts to try to attempt to do that.
Right.
Good luck getting a job at a hedge fund, period, because you've spent all this time on the sell side. And back in the day, sorry, not to age you, but when you were there, you could take risk, right? You could take risk. You can't do that post the financial crisis. So if you're still sitting on the sell side, the reality is you're in more of a managerial role than you are a risk-taking role at a senior level. I think it's candidly become more difficult to even launch coming from most hedge funds. Now, coming from a top flight hedge fund, which has a great established track record and is doing well today, that's exciting to LPs. But that group of funds has become fewer and fewer. And yes, coming out of a fund like a Citadel or a Point72 sets you up in good stead to be able to launch successfully. But think about coming out of some of the Tiger Cubs or related now that are still well below their high water mark. Yep. That's not exactly an exciting value proposition to LPs to say, oh, I'm going to be different, and don't worry about the last 21 and 22. We're doing better now, and my approach to risk management and managing volatility is better than what you've experienced.
Also embedded in Paul's question here is there's the long-short equation has been doing better, but macro has been such an exciting prospect. Currencies, fixed income, the interest rate environment so drastically changing. When you're looking at the types of managers, how much is the macro story part of 2024, and what does that mean for the talent story?
That's a good question, Shanali, because every year I feel like it's a different story in macro. 22 was great. 23 has not been so great, so we'll see what 24 holds. It's a strategy which embodies, as we've seen, a lot of volatility. So I think it's TBD in terms of how they will perform. Talent follows where there is an ecosystem which can navigate that volatility best.
We're now in an environment, an interest rate environment that we haven't been in a long time, where rates went up so much, and now they're going to be coming down. Is there a feeling within the hedge fund community that certain strategies are going to work better in 24 than maybe the past couple of years?
Well, I think the reality is the bar has gone up in terms of not just the market environment, but also what LPs expect for what they're paying. And it's really, the focus is of course on alpha and running in a way which neutralizes a lot of the market risk inherent that has whipsawed a lot of the return for funds. Factor rotations really has obscured great fundamental stock picking, and so being somewhere which can isolate what is value, growth, momentum, macro cross currents, and hedge those things out so that great idiosyncratic alpha-driven stock picking can shine through. That's the most important thing, because then it doesn't matter what the market's doing.
Yep. Interestingly, I want to comment on something you had talked about a little earlier. We were talking about the success of Citadel in multi-strat, but it's also worth talking about the undertone of the other side of that story. You had mentioned that some firms grew so fast, so quickly, and the poster child of that this year was really Schoenfeld. This idea that a lot of money was pulled, billions of dollars was pulled from the firm. They really had to look to raise capital to really fill that hole. They even considered merging with another large multi-strategy firm. Is Schoenfeld alone? Is there other struggles that we're seeing in firms like Schoenfeld, and how does that play out into next year?
Totally. All these funds that grew so quickly, just to talk about who's grown hand over fist, these funds are multiples AUM-wise of where they were even 2 years ago. LMR, Hudson Bay, Synctive, Schoenfeld, as you mentioned, Verition, and you can't do that. You have to be far more deliberate with respect to thinking about what is the end state? How many PMs do I want so that I can maximize idea generation and minimize crowding risk, and then execute against that, and only grow as you've been able to attract talent. And I don't mean bodies, I mean talent. And talent always has options, right? If you're that good, the reality is, as one of those multi-managers that grew very quickly, you're up against the Citadels, the Point72s, the Balyasnys of this world, the Millenniums, competing for those people. So what are you offering that's really a differentiated value proposition? And when I hear of a fund, and this is an actual fund, that grew 8x in that period and now has 150 PMs with no real team underneath any of those PMs, And the PMs they attracted are really science experiments. Most of them have not been PMs before, don't know how to run risk in a market-neutral model, and there's no real resources at the firm to make them better. That's a recipe for disaster. And what we've learned is being a successful multi-manager is not as simple as capital, a pass-through, and PMs. It is far more nuanced than that.
All right, really great to have you join us today, Ilana, and Shonali Bostic as well. Thank you so much. We really appreciate it. Ilana Weinstein there from the IDW group. It's a holiday week, guys. We're almost through it. We're like almost at the end of the year. Thank you very much. And talent always has options. The takeaway line for me. I'm going to get that one printed on a t-shirt. Really great to see you. Thank you so much. Now, coming up here, we're going to turn away from the world of just Wall Street, actually head over to what's going on in the Red Sea, talk about geopolitical risk as we are seeing real disruptions to shipping there. And of course, ongoing questions about how much wider this conflict potentially could get and what that could mean for the economy. So we're going to have more on that next. Stick with us here on Bloomberg TV and radio. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Markets on both Bloomberg Television and radio. I'm Kaylee Lyons alongside Paul Sweeney, and we've gone pretty much officially 2 hours of this program without talking about what's happening in the Red Sea, where so much of our attention has been placed over the course of the last several weeks. Of course, the Red Sea and the Suez Canal, a vital waterway for maritime trade. About 12%, I believe, of global maritime trade runs through there, and it's been severely disrupted because of attacks from Houthi rebels. There is a maritime task force in place that the U.S. has gotten together a bunch of allies to try to make sure defensively merchant vessels are okay to use the waterway, but we know not all of them are feeling safe enough yet. So we wanted to get more insight into what economic impact this is going to have or already has had. Gerard DePippo is joining us from Washington, D.C. He is Bloomberg Economics Senior Geoeconomics Analyst, making you, Gerard, one of the perfect people to talk to about this. How much already has global trade been disrupted, and realistically, how much worse could it get?
So Flexport, the global logistics firm, estimates that about 299 vessels representing 18% of global container ship capacity have been diverted. There are major companies representing more than 80% of overall market share have said they're trying to avoid the Red Sea. I think in terms of how worse can it get, it's sort of already there. I mean, we're already seeing the dwindling interest from the major carriers and trying to avoid it. The hope was that the Operation Prosperity Guardian, the U.S.-led task force, would encourage some to come back. Maersk, the major shipping company, has suggested that it's looking into it. It's not clear whether they've actually committed a lot of ships to go through yet. But the problem, as far as I can tell, is that it's not clear to me what the off-ramp is, right? So that the Houthis can just keep shooting and keep up insurance premiums, even if the naval interventions are successful in protecting those ships.
Hey, Gerard, that's kind of where I wanted to go here. I mean, I don't know, the Navy's got a carrier group in the region. I don't know, if I were somebody, I think I'd be intimidated if I were trying to do some harm there. What's the expectation for, the real expectation, I guess, for what that can do in terms of deterrence?
I think there's a political problem and there's a military problem. The political problem is that there are something like 20 countries that have at least unofficially joined the task force, but a lot of them have not confirmed their participation. I think maybe in part because they don't want to be involved or being perceived as being involved with Israel, and also because they don't want to face any blowback from the Houthis. So the military problem then is if the U.S. were to take offensive actions against the Houthis, those other countries might also be implicated, even if they're not directly participating. And there's also the more direct military question, which is, yes, there is, the U.S. Eisenhower battle group is off the coast of Yemen. There are other ships in the area. But it's not clear to me whether, comprehensive U.S. strikes on Houthi targets would actually stop these attacks. The Houthis were getting bombed for years by the Saudis, and they're pretty dug in and probably dispersed. So I just don't see how this ends. And basically what they're trying on the Houthi side is an asymmetric strategy where they can throw up a whole bunch of drones or cruise missiles or things that are comparatively cheap. And it's the naval task force, which is overwhelmingly the U.S. in terms of actual intercepts, will then have to shoot up much more expensive missiles to intercept them. And over time, that gets quite expensive, and the Navy isn't reporting what its inventories are, but there's a question to me of how long can this last?
Yeah, it's such a good point, Gerard. And I actually had a conversation about, the costs of these defensive measures and shooting down these drones last week with Congressman John Garamendi. He's a Democrat from California, serves on the Armed Services Committee as well as the Transport Committee. He used to chair the Maritime Transport Subcommittee. And he also brought up kind of what you were just alluding to, this idea that the Saudis tried for years to go directly after the Houthis and limit their ability to launch these kind of attacks. And that was unsuccessful. And he was unconvinced the U.S. would be any more successful. So I just wonder if we're looking here potentially at an elongated period of at least tension, if not outright conflict in this region, and if it's going to be there for a longer term rerouting of how trade moves around the world.
I mean, our baseline assumption is this is going to last at least weeks, if not several months. I don't know how many munitions the Houthis have. Maybe some in the U.S. government might know that. But in general, all they have to do is send up an attack every 2 days, 3 days, or whatever. I don't think they've actually attacked since Tuesday, but that's enough to spook the maritime insurers, right? And they don't even have to get actual direct hits. They could still, the military mission to protect their ships could still be succeeding, but still spook markets. So yes, I would plan on this being at least somewhat prolonged.
And is that kind of what we're hearing, Gerard, from the shippers? Because I kind of feel at the end of the day, it's the shippers and maybe even the insurance companies which are kind of calling the shots here about whether to transit the Red Sea and the Suez or not. What are we hearing from them, I guess?
Yeah, I mean, so the insurance rates have jumped, I think, quadrupled maybe over the past few weeks. The overall shipping costs, I should add, are much lower now than they were a year or two ago, which is really the economic relief and why this is not as bad as it would have been, say, in 2021. But I think they're mostly in wait-and-see mode because, again, even if the Navy is intercepting all these cruise missiles or anti-ship ballistic missiles or drones, it only takes one to get through and actually hit a ship for the insurers to actually have to pay out.
Yeah, so obviously we think about that in terms of cost for these companies, ultimately how that feeds through to their end consumer, how much of that gets passed on, what the inflationary impact of all of this is. When we look, though, at what specific economies would be most impacted by that, Gerard, how are you mapping this out across the world?
So we looked at data that showed that ships that transit to Suez are primarily going to, obviously, Egypt and those in the area, but also Europe. So it would include like Romania, Greece, and others. those would be directly affected, but there's also rerouting costs, right? I think in general, our view is that the inflationary impact will be quite muted, in part because shipping costs are so much lower now than they were 2 years ago. And in general, shipping costs don't account for a large share of CPI, including in Europe. I think the bigger question to me is how much does it affect inventories for things like consumer goods? Companies weren't planning on this happening, right? So what might have been a 10-day journey is now a 15-day journey or whatever, and it makes it harder to plan for that stuff. I think over time, markets will adjust those. So overall, I'm not too worried about it. I'm more worried actually on the military side.
So I guess, Gerard, what are we hearing from the administration about how far from a military security point we're prepared to go, the U.S. is prepared to go? Have we kind of heard any updated policy?
I mean, they've certainly explored options. I'm sure they're updating their potential strike packages. I think part of the issue is that other countries don't want this to happen, in particular Saudi Arabia, which has a very tentative truce with the Houthis. And if the Americans, and it would mostly be U.S. forces, were to attack the Houthis, the obvious counterplay by the Houthis would be to attack Saudi infrastructure, which could have larger ramifications. So it's a very delicate situation.
Yeah, which gets to the idea of energy and energy flows being disrupted, as Saudi Arabia clearly is a massive producer of crude oil, and that would have ramifications globally. How do you think about the Saudis and other Arab allies in all of this? Because at the end of the day, this is not a decision that the U.S. makes in complete isolation.
The Middle East is always complicated. It's extremely complicated at the moment. Supposedly the Emiratis are more supportive of strikes. It's the Saudis that oppose those strikes. Oil markets are actually down in the past few days, so we haven't really seen a lot of indication in markets, whether for Dutch, gas indices or Brent oil, right? So I think it's okay, and it's not like this is something that the markets are ignoring. They're certainly focused on it. But the worry is that if say, the Houthis were to attack Abqaiq, which they did a few years ago, or maybe there could be disruptions in the Persian Gulf, which would compound issues, particularly for oil markets. That's the real downside risk.
All right, very good. Gerard DePippo, thank you so much. We appreciate it. Gerard DePippo covering the trade aspect of what's happening in the Middle East here, as again, the Red Sea, a lot of folks, a lot of shippers are avoiding that area and choosing to go all the way down the coast and go around the southern tip of Africa, and that is saying something, 10 to 12 days of extra transit time.
Yeah, it's extra fuel, it's extra cost, it's more delays. And Paul, I think we're all so conditioned by the experience of the last several years during the pandemic and the way supply chains were so disrupted and how long it took for retailers to normalize their inventories, for all of those things to get ironed out. We're just now seeing that real pressure being released in terms of goods prices, even though services inflation is still maybe partially a problem. But because we're all so conditioned by that, I think that's why we're so keyed in on this, even as Gerard says he doesn't actually expect it to be as inflationary as maybe
Exactly. I mean, we kind of all grew up with just-in-time inventory, and I think the pandemic and the resulting supply chain disruption kind of changed people's opinion on that somewhat. Now kind of maybe just-in-case inventory, maybe onshoring, friendly shoring, just ensuring that you have greater security of your supply chain. And here's another example of a vulnerability. Looking at this market here, let's just call out the S&P 500 here for just a moment. We're up about 6 points here, 47.87. Keep in mind here some of the highs. The closing record high, 47.96.56. That was January 3rd, 22. The intraday record for the S&P 500 was 48.18.62. That was on January 4th of 2022. So we're getting close to the closing high and intraday highs here on the S&P 500. We'll keep an eye on that today. That's a little bit of fun here to close out the year, even on a relatively...
one trading day to go.
Exactly, a quiet market. Maybe we get it done on the last day of the trading, get back to that intraday high, closing record high. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president is calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
DOJ or other authorities.
Could face bigger challenges.
It was going to keep Rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, welcome back to Bloomberg Markets, hour number 3. That means Caroline Hyde joins us here in our Bloomberg Radio studio, because we are simulcasting on radio and TV. We can do that, Caroline. So welcome back for another day.
Oh, it's a joy to be with you, Paul. And another day of heady heights for the NASDAQ 100, another day of record gains, another day of talking all things AI and Red Sea. It feels as though really this week in between the festivities is one of a narrative that builds.
Yes, it's a lot of news heavy, not necessarily market moving news heavy, but a lot of geopolitical news, a lot of company news, some markets news as well. So we're staying on top of that.
And let's get to these markets because, as you say, we do manage to just inch our way higher throughout. And on this third hour of you helming, we'll look at the NASDAQ 100 currently up 0.1%, and it is at a new record high. I mean, we could keep an eye on the S&P 500 ever so close to its own record as well. We're only up 5.6 points, let's call it 4,787 where we trade. A 7-year auction on deck at 1 p.m. New York time. We're up some 4 basis points, so a little bit of weakness in the bond market after what has been, well, some stellar demand for the 2s and the 5s got auctioned earlier this week. I'm looking at the Japanese yen. Could we, after the first time since 2007, finally see some sort of rate hike baked into the spring? That's where the BOJ seems to be guiding us. Dollar weaker by some 0.5% versus the Japanese yen. But fascinating when we look across some of the corporate news as well, as you say. And for one, we do that with Abigail Doolittle. Always great to have her in the house. And what are you keeping an eye on in terms of driving some of these gains today?
Well, before taking a look at the gains, let's take a look at a big story stock on a relatively quiet day, quiet week between Christmas and New Year. And that, of course, is Boeing. Shares are down about 1.25%. And this story is not so comforting. I've actually been trying to figure out where I'd like to go on holiday over the next couple of months.
Not on a Boeing?
And, yeah, well, loose components were found on the rudder of a 737 MAX. Of course, this is the plane that tragically a few years ago was involved in, I believe, 2 crashes, was it? I know it was more than 1. I don't think it was 3, so I do think it was 2. But please feel free to correct me if I'm wrong on that. Now, Boeing is saying it's been fixed, but they are recommending to operators that they inspect and report any loose hardware. They're saying these planes can fly safely and deliveries can continue. But again, it's just not comforting. If it were a real issue, though, for Boeing, I think that you would see the stock tanking. It is down 1.2%.
We'd see the FAA come in much more aggressively.
Yes, that's a good
personally,
point.
I feel the safest on a 737 MAX.
And why is that?
It's been the most inspected plane of all time.
At this point, yeah.
Of all time.
That's not
and
bad.
there's 5 billion of them in the air. So,
okay,
and I've flown on them 1,000 times since. But the big thing for Boeing is to get China to really start.
There were indications just a couple of weeks ago that was going to happen, that China was going to start receiving their first deliveries of, I think it was the Boeing narrow body 787.
Yes.
Who knows whether or not this flows into the 737 calculations at some point. But again, at this point, it seems to be in the past. But again, not so comforting. But I will take comfort from your analysis. And maybe that's the plane I will aim for when I do take to the skies.
He's a glass half full kind of a guy. Meanwhile, I mean, digging on some of the gainers. I mean, we've got some analyst moves coming in on Tesla. What are some of the other companies you're keeping an eye on?
So yes, Tesla is up for a 3rd day in a row. And you know, something I want to point out on Tesla before we talk about, actually, it's now down. I apologize. It had been up about 1%. Now it's down
Tesla?
about 1%.
Look again and it moves.
Yeah, I know. It's you have to kind of keep an eye on it, you know, move by move, second by second. But something I will say, what a difference a year makes. If we were speaking at this time last year, the stock was down more than 60% on the year. Everybody hated Elon Musk and Tesla, and here we are, you know, a year later, the stock is up more than 100% on the year. Relative to today, we do have the stock higher, despite the fact that China's Xiaomi is revealing their first EV. The CEO saying that within 20 years, they plan to be one of the top 5. There's also chatter of an India factory. That did, again, have the stock higher earlier. Now it's not. Microsoft, I was about to say perma-bull. I'm not sure if that's fair, but that's a positive. That was a class.
Well, who are we talking about?
Dan Ives.
Perma-bull.
Perma-bull, yes.
That's where the term came from.
Yes, and so
he's been bullish.
He's been correct. Yes, I mean he's had a few moments where markets have obviously gone down. I guess 2022 was sort of a difficult time, but over the long run, yeah. So he's raised his price target to 450 from 425. This is really interesting. He maintains his outperform. Now this is a big call. So if we characterize it from a perma-bull, he's saying that the Copilot monetization is, quote unquote, game changing. And over the next 3 years, 60% of Microsoft's installed base will be using that AI functionality. He's saying it's their iPhone moment. That is big for somebody who always makes big calls. Now, I will say I'm somebody who has my defaults browser set to MSN for better or worse. I just like some of the, I was about to say silly stories, interesting stories before I, go and do whatever work I'm doing. But will I be using the AI functionality? Unless I have to. I have no interest in doing that. So I guess I would be in that 40%. And then Penn Entertainment, let me just make sure that it is higher. Yes.
Yeah.
And nicely so, up 7%. This after HG Vor Capital Management has revealed an 11% stake. They're seeking board seats. They've met with management. They believe the casino company is deeply undervalued. Down 40% roughly over the last 2 years, down 15% this year into today. So you can make that case of deeply undervalued.
All right, good stuff. Thank you very much, Abigail Doolittle. She covers all the markets for us here at Bloomberg. I want to pivot to Cam Harvey. He is professor of finance at the Fuqua School of Business at Duke University, my alma mater. I took a couple classes from Professor Harvey. I survived. I'm proud to say I can't claim any more success than survival, but some good stuff there. Hey, Cam, I look at the 10-year Treasury. I mean, I'm not a bond guy, but I mean, just a cup of coffee ago, the 10-year Treasury was at 5%. Now we're at 3.82%. What's going on out there?
Yeah, so it overall is very good news that rate has gone down. And I think that that investors and consumers have revised their expectations of inflation. And this is good news. So it means that the Fed has stopped and is now talking about decreasing rates, and that pressure on the long-term rates seems to have abated.
So, Cam, I mean, the market's pricing in multiple rate cuts for 2024. Do you think the market's maybe a little over its skis here, or is that something that the Fed should be considering?
Well, the last time I was on, I was making the case that the cuts should have begun in 2023. So the Fed overshot by pushing the short rates up so high, and the sooner that they take down some of these cuts, the better, because it does cause a lot of stress in our economy. And that stress is unnecessary given that inflation, according to my calculations, is running well below 2%.
And Professor, let's dig into those calculations because they're fascinating. I love reading your work, whether it's across LinkedIn or more broadly. And for you, it's housing, right? This is where the misinterpretation is coming in.
Exactly. So housing is operating with a lag. So it's not like current rents or current housing prices. We changed the way that inflation is calculated back in 1982. So before 82, it was real-time inflation in housing. But now it operates with a lag. So the housing inflation that's reported in the CPI is inflation that happened a year ago. And that component of inflation is 35% of the overall inflation. And the reason inflation has been high is that the shelter component has been running at 7%. That's what goes into the CPI. But we know that's not the case. If you look in real time, rental inflation or house price inflation is near 0 or 1%. And if you recalculate the CPI with real-time shelter costs, then what you see is a real-time inflation rate below 2%. And this has been very frustrating because this shelter component caused the Fed to make a mistake early on in declaring that housing was no big deal and inflation was transitory.
Yeah.
And it caused them not to move, to keep rates so low for so long. And then the same mistake was made in 2023. It was obvious that the only reason inflation was high was because of the shelter inflation that had happened in the past. Policy needs to be executed based upon real-time data, not on data that happened like a year ago.
In the world I cover more, which is AI, we say a lot garbage in, garbage out. So how are you having conversations as a professor, of course, over there at Duke? Are you trying to get this message across? Are you hearing that it's falling on deaf ears or more ears that are willing to listen to some of the data that should be taken into account when it comes to inflationary pressures?
So this has been like more than a year-long campaign for me. And again, I'm very pleased that the Fed has changed the conversation. And the sooner they move, the better. There is still a lot of risk out there. So like I know people are patting the Fed on the back, congratulations, mission accomplished. No, it's way, way too early. My inverted yield curve indicator, which is 8 out of 8 in predicting recessions since the 1960s, we are at the average lead time to a recession. So if you look at the last 4 recessions, the yield curve inverted on average 13 months before a recession, and we are at month 13 right now. We're at the average. So again, it's way too early. There are significant headwinds. The Fed can help things by reducing the Fed funds rate as soon as possible.
Hey, Cam, I know you also do a lot of work on blockchain, crypto, fintech. You teach a course down there at Duke, Innovation and Crypto Ventures. What's the theme that you think we should be on the lookout for 2024 in this space?
So it's interesting that we've got 2 simultaneous disruptions happening. So one is in decentralized finance, to change our payment system and to allow for functionality that we've never had before. And we've got AI going on at the same time. So I look at this in kind of the big picture, And the big picture, the thing that worries me a lot is just the size of the U.S. Debt. So the service on that debt is about $700 billion a year. And that service will increase in 2024 to be the second largest spending category for the government. So the way to get out of this problem is, well, there's three different ways. One way is to increase taxes, and that just kills growth, and nobody wants increased taxes. The second way is to print money and to inflate our way out. So you print the money to pay off the debt. And that is just like a tax also. So nobody really wants that. Nobody wants to go back to that inflation. The third way is with growth. So if we increase our growth rate, then it naturally increases the tax revenue and allows us to pay down some of that debt. So we are at a cusp of a pivot point, in my opinion, in the economy with these two disruptions going on, and they potentially allow us to get on a different growth path. And it's really important that we do not fumble these opportunities by over-regulating either decentralized finance or AI. We need to embrace these disruptions and to look at the benefits, not just the costs. And I'm not saying this is without risk. There is risk, but the key thing is to get on a higher growth path. I don't think it's unreasonable.
All right, Cam, that's great stuff. As always, Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University. Great place, highly recommended. Good stuff there. Looking at the markets here, Caroline, we still got a little bit of green on the screen here. We're 47.88 on the S&P 500 on that 47.96 watch, which would be the closing high for the S&P. We'll keep an eye on that. Oil, $78.68. That's down. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Markets Across TV Radio for you today. Paul Sweeney, Caroline Hyde. We dig into the geopolitical news of the week, of the month. Of course, the narrative continues to build about the Red Sea. And, of course, Houthi rebels been seen to be attacking certain vessels. And it basically redirecting, we understand now, half of all container ship fleets now currently no longer going through the Red Sea. They're avoiding the route. This is according to new industry data that overall is one that we can probably corroborate with our next guest. We're pleased to welcome to the show Anton Posner, who's CEO of Mercury Resources. And you're all about negotiating skills. You're about professionals from an industry basis helping you plot out your dry cargo issues. When you are looking at such a difficult supply chain management conundrum, what do you advise at this moment, Anton?
Yeah, thanks, Caroline. So at this point, it's a lot of wait and see in what's happening with the international coalition. We are partners at Ifcor Galbraith and Mallory Alexander on the container side. It's right now a lot of hand-holding with our client base on the commodities sector to guide them through what's happening in the markets at this point. So we're seeing, of course, increased freight, increased insurance, a lot of uncertainty and mixed signals from ship owners, container lines, and from governments on what's happening to basically mitigate the risk and the threats that are out there from these Yemeni armed groups.
I mean, yeah, talk to us about some of the mitigation of the risks. The fact the U.S. Navy is leading this military partnership. You are out there talking to the brokers, the shippers, the governments, the port authorities. Mm-hmm. Do they take this as some sort of easing of concern, or are they still wanting to hold back?
Yeah, we're seeing some easing of concern. Ship operators on the container side, like Maersk, CMA, CGM, are starting to signal a return to going into the Red Sea and the Suez Canal. Some ship operators on the container side, like Hapag-Lloyd, are still holding back and not even announcing any kind of return to that market. On the dry bulk side, which is a huge part of our business, dry bulk commodities. Ship owners right now, it's naturally a time of year where it's where things have slowed down. So we're seeing ship owners on the dry bulk side diverting ships that are already en route and rating new cargoes for January, February timing is more of a let's see what happens after New Year's and what's happening on the side to on the news to mitigate what's happening there with the military response. So of course we've seen the Navy move the USS Dwight D. Eisenhower into the Gulf of Aden and off the Yemeni coast. This 20 nation coalition that the United States announced is seemingly coming together, but there's been some hesitancy from a couple of, some of the U.S. allies, and some nations have been reluctant to even put their name attached to it yet. So definitely still some concerns and not a lot of comfort.
Anton, who ultimately decides whether a ship does transit the Red Sea and the Suez? Is it the insurance company, the ship owner, maybe the captain himself or herself? I mean, who really at the end of the day makes that decision?
Yes, and yes, okay. Right? It's a very much a combined situation. Ultimately, the master of the ship, the captain of the ship, has the ultimate say, right? But they're taking instructions from the ship owner. But in this situation, really in all situations regarding commercial and merchant shipping, you have many layers on top, right? You have the ultimate ship owner, the company that owns the ship. You have the master that has ultimate responsibility for the ship. And then you have the ship operator, the company that's often time chartering the vessel and has some say over it. So it's very much a combined decision. So even if a ship owner wants to order that ship to transit through the Suez Canal and the Red Sea, if the master is not comfortable, right, the master can basically say, we're not taking her through.
I just kind of learned today through some other discussions that while yes, having an aircraft strike carrier group in the area is certainly intimidating and certainly represents a tremendous show of force, at the end of the day, what can it really do against a bunch of terrorists? What's the belief in the industry about what it can really achieve?
Yeah, right now, without having the international will to do something and the geopolitics going on over being seen to align, for some of our NATO allies in this case, right, to see themselves to align with the United States on the mission to deal with this. It's been walking a tightrope, right? So we're not even seeing strong rhetoric from some nations on the issue, let alone deploying actual military assets and naval assets to the situation. Some of what's been written about this, about the coalition that's coming together, as some NATO allies have, instead of deploying a destroyer, a frigate, let alone any kind of hardcore military assets, they're deploying one staff officer to the team. right? So what signal is that sending to Yemeni armed groups here? And to ship operators, right?
I mean, to that end, I mean, what's fascinating is just how global and interconnected the shipping world is. I think in some of your notes you were talking about one vessel, which is Liberia flagged, Dutch operated, Japanese owned.
Right.
To that end, how does geopolitics in and of itself affect the business of shipping? Are people having to decide whether or not they work alongside certain alliances that they've always usually done so? How is that playing out in the world in which you work?
Yeah, absolutely, Caroline. And what we're seeing is situations, hardcore examples now of ship owners, dry cargo market, one example that comes to mind, right? A dry cargo ship operator that's working on a voyage of a dry commodity is actually asking a large international trading firm that's their counterparty on that, if there's any Israeli involvement in the trade, let alone put aside the ownership of the vessel, the operations of the vessel, where the ship is going to, put that all aside, just whether or not there's any involvement by Israeli companies in the actual trade of the commodity in that particular sense. So this is really, far-reaching, right? Something else that as I was researching and getting ready for today, interestingly enough, we're seeing ships now transiting through the Red Sea that are using their AIS system that's usually used to transmit data on the ship's position and load port and discharge port, an ETA. They're using that instead of showing a discharge port of, let's say, Piraeus, Greece. They've replaced that with information that says armed security aboard or no Israeli involvement in the ship. In the slot where you would put the discharge port or the destination port, so that it transmits through to the Yemeni armed groups, right? That they could see that information as they're tracking the ship. In addition to what's allegedly an Iranian spy vessel, that's been lingering there too.
And just about 30 seconds left. I mean, is there any realistic solution here other than, I guess, the cessation of hostilities in the region?
Yeah, I think the other solution is potentially and very unsavory, right? A military solution to dealing with what's going on the ground in Yemen. And of course, I'm no expert in military matters in terms of how to deal with that. So I wouldn't even venture that. But you could imagine if we're dealing with a situation where United States NATO allies are not even willing to send more than a staff officer to a joint naval task force, where's the will to deal with this on the situation on the ground where the attacks are originating from?
Well, you served as an officer in the U.S. Naval Reserve, so you know a bit more than we do here in the radio studio. But we really appreciate your time, Anton. Absolutely fascinated to get an on-the-ground feel of all the negotiations you're currently having. Anton Posner is, of course, the CEO of Mercury Resources. And, well, sort of from one area of tension and concern, we turn our attention perhaps to a future area of concern, certainly one that's more in the realm of technology, Paul. This one is more about AI, and we're looking into a future of trying to regulate it ultimately. And just think of the key New York Times news that they're suing, of course, OpenAI and Microsoft. This is going to be a key copyright headache going into 2024.
It is, and we saw it come to the forefront in Hollywood just recently with the writer's strike. They want protection, as do the actors, from potential AI threats.
So much to digest when it comes to the future of artificial intelligence, the pros, the cons, the regulation thereof, and indeed what the market outlook is. Stick with us for that conversation. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
All right, welcome back to Bloomberg Markets. Caroline Hyde and Paul Sweeney. We are simulcasting on both Bloomberg Radio and Bloomberg Television here on the second to last day of trading in 2023. A little bit of green on the screen here. The S&P, the Dow, the NASDAQ, they're all up about 0.1%. Yields holding pretty steady. Got the 10-year Treasury up about 3 basis points, 3.82% on your 10-year on the commodity space. WTI crude oil, despite all that's going on in the world, is off about 1.5%, just below $73 per barrel. Bitcoin, it is off 1.8%, 42,600 on the cryptocurrency. The SEC is stepping up its oversight of AI. Wall Street is actually preparing for the regulatory agency to finalize a number of rules by April, including a rule to assess whether the use of predictive data analytics poses conflicts of interest. Let's discuss with Alexander Semenova. I mean, Alex, there's so much we don't know, don't understand about AI other than, boy, you better have exposure to AI. But a lot of people are saying, hey, let's just slow down a little bit. There might need to be some regulation here. How is it? What's the SEC thinking about this?
Yeah, great to be on with you guys. So first, taking a bit of a step back here, the SEC is basically rushing to safeguard some of its rules in case of future changes in Congress. It's aiming to protect about 24 rules, specifically ones related to climate disclosure, as well as how private funds, including hedge funds and private equity firms, deal with investors, which involves how they disclose information on their fee structure and any potential short sales. And another key rule here is also related to artificial intelligence. That is one of the standouts. The SEC, like many regulators, has of course been ramping up its scrutiny of AI, and understandably so, because we had this initial euphoria this year, and now they're kind of really taking a closer look at what the implications actually are, specifically in the investment space. So in July, they proposed a rule requiring that broker-dealers and investment advisors assess whether their use of predictive data analytics poses any conflicts of interest, and if they do, they have to eliminate those conflicts. So they're trying to protect that rule in case there's a Republican administration.
Ultimately, if the AI recommends to a certain client they do certain type of trade, but that happens to be beneficial to the bank or the broker, that's something to be taking on board. Bias, of course, has been a key concern as well within financial access. What I'm interested, though, also is, well, ultimately where the data is being sucked from. These models are being built on a whole trove of information, some of it clearly true, some of it at times not. And where we're now starting to see some of the tension build from a regulatory perspective is also within the area of, well, copyright, of ultimately what these foundational models like the large language model of OpenAI has been trained on, for example, New York Times. We're just thinking about the suing of the New York Times of OpenAI, of Microsoft, and this seems to be quite a significant challenge.
It is indeed significant. So the New York Times is actually the first media giant to sue AI companies over their practices. We've had authors suing them, but never a media giant in this form. It kind of underscores the contentious relationship between media and technology. Basically, the New York Times filed a lawsuit against OpenAI and Microsoft for copyright infringement. They say that the companies have been using the publication's content to train their chatbots and other AI features. Basically, they're saying that they're using millions of copyrighted articles for OpenAI's ChatGPT and some other technologies that they have. And the lawsuit alleges that this has caused billions of dollars in statutory and actual damages, though they don't specify any kind of monetary demands in this lawsuit. And again, this isn't quite new because there have been some suits against these AI companies, but never from a media giant like the New York Times. So really significant here to see how that will play out.
Alexandra Simonova, we thank you so much for spending some time with us, breaking it all down. And we want to get some expertise in this area, where the risks are, also where the opportunities are to be investing in this sort of technology. We're pleased to welcome Jake Saper, his general partner at Emergence Capital. And Jake, you know, the retort coming from the likes of OpenAI and the other foundational models has been fair use. And ultimately also the fact that they've been trying to get ahead of this in some way by striking deals with Axel Springer, I think, the key publicist over in Germany, where they've sort of licensed some of their particular use of publications and writings. What will the New York Times case mean, do you think, for the training of these models? Can you put the genie back in? Can you in any way take out New York Times's own articles from the training of OpenAI's model?
Yeah, it's a great question, and it's great to be here. What I'd say is this is going to create a lot of movement towards exploring open source models. So OpenAI is the champion of the kind of closed source model ecosystem, which means that the data that they're training on and the code that they actually generate from it is not publicly available. And so there's lots of questions now around transparency. What data are they using? What can we use as a business if we're going to use their OpenAI models? What is happening now is an increased interest by people that consume models to explore open source models, where the data that is used to train those models is clearer, and you, as the user of the model, have the ability to manipulate the model themselves. So we think that 2024, and certainly the advent of this lawsuit, is going to push businesses who are using this technology to consider open source models more seriously.
So I think I'm getting comfortable with what AI is, and that's a big leap for me because it took me most of the year here. Now my question is...
the last time we talked about it.
Yeah, I just need some help on what do you think in 2024, Jake, might be some of the use cases that maybe will help the general public get a better feel for what generative AI is and what it can mean?
Yeah, well, I think the good news is in 2024, we're going to move from kind of prototyping land into production. A lot of these applications are going to actually get launched and are going to have real impacts for consumers. You know, as you know, we focus on B2B software investing at Emergence, and we think there's going to be a bunch of exciting applications of AI in 2024. Give you one example. We work with a company called Doximity, which is, the shorthand is LinkedIn for doctors. And they provide a whole suite of tools for doctors in addition to just a social networking application, but they help doctors serve their patients. One of the things that they're using AI to do is to help doctors draft letters to insurance companies to get approval for treatments. Right, that has massive implications for not just the doctors, but also obviously consumers and getting, you know, much more efficient. That type of thing wasn't possible a year ago and is increasingly possible today. So you're going to see those types of things come to fruition. We have worked with a company called Ironclad that's in the legal contracting space, and they help companies draft contracts using AI more effectively, which allows people to process contracts more quickly and ensure they're correct. So you're going to see them kind of seep into all sorts of applications across the business ecosystem.
A new phrase for me, and there's a lot of new phrases I'm learning as it relates to AI, co-pilots that ensure that humans stay engaged here. Explain what that concept is and what are some interesting companies that maybe you've seen with that tech?
Yeah, so imagine that you are you're on your computer and you're searching for some piece of information. The idea is historically you would go you know, to Google and look externally, or you would kind of scour all your documents internally. A co-pilot will actually pop up and give you not just a link to something, but actually an answer. We work with a company called Guru that does this exact thing. So the idea is instead of searching across all of your applications, the information is actually serviced to you directly. So the concept of a co-pilot, to boil it down, is as you're doing your job, you have an assistant that is kind of next to you that helps coach you on the right direction to go. Now, critically, there's a difference between a co-pilot and an autopilot. Autopilot is dangerous, right? Because that's when the human shuts off their brain and the plane flies itself, and that could be bad, or it could be good. As you're building these co-pilots, as you're building these coaches, you need to ensure that the human stays engaged and is actually inputting their thoughts and creativity and double checking into the software. Because as we all know, AI is not perfect. There are errors that are committed all the time. That's okay in consumer applications. If you're chatting with a dead celebrity using AI, it's okay if it's wrong, right? But if I'm drafting an important legal contract, or if I'm communicating with an insurance company, I need to be ensured that it's bulletproof. And a core way to do that today is to ensure that the human is engaged with the co-pilot and not just clicking accept, accept, accept on whatever it suggests.
When you're looking at the valuations of the companies that you're eyeing in the B2B space, or more broadly, when we're talking of the latest $100 billion valuation of OpenAI, when we're thinking of Anthropic reaching a revenue run rate of $850 million and potentially being valued more than $18 billion, are those valuations realistic if open source is going to become more of the valued foundational model direction of choice? Or do you think really still these valuations are going to be the right sorts of amounts for them?
It's a really great question. There are lots of great closed source companies like the ones you named. As open source becomes more and more viable in 2024 and beyond, we work with a company called Together that helps companies actually use open source models more effectively. There is going to be pressure put on these open source models. And so the key thing to check as you're evaluating an investment in a closed source or really any AI opportunity is retention. These things are getting incredible adoption, right? Initial adoption, people are playing with this stuff, experimenting with it, prototyping, et cetera. But the core thing that will matter in 2024 in AI is retention. Are people that start using the product continuing to use the product? And the key question, as you alluded to, is in these foundational models, it's easiest to start with a closed source model because it's all packaged for you and you can just get it up and running quickly. But if open source models become more preferred, either because they're more easily manipulable or because of the New York Times driven concerns around where's your data coming from, there's going to be some downward pressure on these closed source models, which could put pressure on retention, which could ultimately put pressure on some of those valuations.
And Jake, how are you trying to analyze the regulatory outlook for 2024? As you make these investment decisions, how are you trying to preempt? It feels sort of like crypto all over again. Everyone's trying to get ahead of where the SEC or indeed more broadly, we've had an executive order here in the US, but this is going to come down to global regulation. We've seen the EU with its AI Act. How do you front run that?
Yeah, well, I think transparency is really important. Like understanding where you get your data from is really important. You don't want to be using copyrighted data to train your models, right? That's like, it's obvious, but I think people are going to be paying much more attention to where that data comes from. I think similarly, trust is going to become much more important, not just in terms of where your data comes from, but is that data actually believable? Bad data going into a good model is going to create a bad output. I work with the CEO of Guru, Rick Nucci, calls this truth washing, which is where, okay, I'm using data that comes in and the model spits out an answer that sounds really confident but's wrong. I think going forward, there's going to be a much greater impetus put on how do you validate the data that went into training the model is not only legal for you to use, but also accurate so that the input or the output that comes out of the model can be trusted. So as we think about evaluating investment opportunities, we're thinking about it from a first principles perspective, which is a belief that regulators are going to move in the direction, thank you, Apple, for the use of the thumbs up there, that this technology is going to move in a direction where regulators are concerned about, okay, are you allowed to use the data that you are using, and is the output that's coming out of these models trustworthy such that good things can come from it?
30 seconds, Jake. If I bring a cool AI idea to Sand Hill Road, can I raise money?
Well, as we talked about last time, Paul, Sand Hill Road is that's the past. The future is San Francisco, the Embarcadero. That's where the cool things are happening.
Oh, nice! I like that.
But to answer your question, can you raise money? Well, first I would look at your background, and I think you're an incredible interviewer. I don't know how technically savvy you are.
Right.
But I mean, the reality is. There is going to be more scrutiny in 2024. Right? Yeah, exactly. Come to me with a media company, I'll write a check all day long. There is going to be more scrutiny of AI investments going forward. And I think the key thing people are going to be looking for is that retention point. In 2023, so many AI applications were getting so much tire kicking, and lots of people were using the product for a week, 2 weeks, 3 weeks, and then they would get bored or try the next hot thing, et cetera. What investors are going to be increasingly looking for in 2024 is, okay, yeah, you've got a lot of people to start using your thing, but are people continuing to use the thing indefinitely and continue to get value out of it?
Right. All right, Jake. Once again, thanks so much for joining us. Really appreciate getting your insight there. Jake Saper, founder and general partner at Emergence Capital, getting kind of the latest, the rundown of what's happening in the world of AI. Just burst onto the scenes in 2023.
Yeah, this time last year, I mean, December, what was it, November, December 2022, we started to play with it. 2023 just took the narrative and ran.
Exactly. And we all think back to me, the seminal moment was when NVIDIA put out that revenue guidance early in 23, and it just blew everybody away, and I think blew the company away. They're like, oh my goodness, the adoption here of this technology is extraordinary. So anyway, we're going to stay on top of that, and there's a lot of smart voices we bring on to help us get a little bit smarter here. Looking at the market, still a little bit higher here, up about 0.2% on the S&P 500. Coming up, we're going to get the latest on the housing market. That's coming up. This is Bloomberg.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
DOJ or other authorities
Could face bigger challenges.
Was next. Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
We welcome you back to Bloomberg Markets across TV and radio, where there is just a sprinkling of economic data on the day. Not much, a bit of jobless claims that came in slightly higher than expected. But we want to go to pending home sales, which perhaps were a little bit more lackluster than had been thought, with Simone Foxman to break it all down for us. Just tell us a little bit about what happened for the month of November and why it didn't live up to the hype.
Yes, strategists were expecting that pending home sales, so this is a measure of existing homes from the National Real Estate Association, would tick higher. And the rationale was that mortgage rates have come down pretty substantially since hitting a high in late October. We just got the news from Freddie Mac that we're seeing the lowest mortgage rates since May, now 6.61%. And so the idea was, well, this is really going to drive people out. They're going to start buying homes. And we're going to see that in the data. Now, we didn't get that because pending home sales were flat on a month-on-month basis. They're still down quite a bit, down about 5% on a year-on-year basis. And so what this signals to us is the activity in the home market may be coming, but it's not here yet.
Well, I did my effort here for the housing market. In March, I bought a sprawling estate on the Jersey Shore. Used a 6% mortgage. I felt like a complete knucklehead because everybody else, like Matt Miller's locked in at 3%, Alex Steele's below 3%, and here I am paying 6%. But then it went up to like 7.5%, 8%.
And then you felt
I felt
really
pretty smart.
intelligent.
But I mean, now with the rates coming down, I wonder what the level is that'll entice somebody who's sitting in a home to saying, okay, I'll take the higher mortgage risk and I'll sell and get some of those existing homes selling.
It's going to be really painful. I mean, the consensus is somewhere 5.5%.
I think that's right.
Feels okay. You know, it's not as good as, you know, if you were able to lock in a 3-something% rate. Certainly not even folks who got better than that. But, and I think, you know, Katja Dimitrieva and Michael Sassow have this great story out. It's on the terminal, it's online, talking to a bunch of home builders and real estate brokers who are all saying, looking ahead at the impending, I guess, what the street hopes for rate cuts coming next year, and saying they're really excited. They're seeing a lot of interest on their websites. They're fielding a lot of calls already. And 2024, in the spring, it's going to start being a different story for them.
All right, good stuff. Simone Foxman, she covers the equity markets for us here, bringing us up to date on kind of what we're seeing in some of the data for the housing market.
I want to know more about the sprawling Jersey Shore house.
Yeah, well, maybe at some point in the summer we'll have you down. You know, home builder stocks are on just a tear this year. They're on pace for the biggest annual advance in over a decade. And you know, the research coming off of Wall Street on the housing stocks and the home builders is so much better today than it was, say, 25 years ago, where those has-beens had to go into management. We're joined by Drew Redding of Bloomberg Intelligence, one of those good analysts who covers those housing companies. Drew, what's the outlook for 2024 for the housing stocks, the home builders, after such a rip here in 2023?
Yeah, I think where we sit now as we head into 2024, we look at the large, well-capitalized, publicly traded home builders as kind of sitting at the top of the housing food chain. We think that the broader new home market is positioned to take further share from resales. And we think within that context, we think that the publics are kind of the leaders of the pack here. More broadly, the new home market should continue to benefit from a lack of listings in the resale market. And, you know, as has been well discussed, the builders have done well to attract buyers through financing incentives, so they're offering their buyers lower rates. Now, as it relates to the home builders, we think that some of the smaller private builders will have continued difficulty getting access to growth capital, because a lot of that comes from some of the smaller regional banks who may be facing some difficulties should the economy slow a little bit. So we think that the large public builders are in a good position right now.
To that point of where the banks are being hit, is that because they've got so much exposure to resi, or is it more to commercial?
I think it's just a lack of willingness to extend financing to the home building space under the guise that the economy might start to slow. Everybody remembers what happened last time, you know, when the builders were overextended. So I think it's just broad economic uncertainty that's causing a pullback from some of those smaller regional banks.
All right, so talk about valuation in this group, because you got to be pushing the limits here, don't you? Or are the earnings keeping pace with the stocks?
Yeah, it's a good question. I mean, the stocks are up 70% year to date at the index level. They're up 50 to 130%, depending on the name you're looking at. You know, right now the group is trading at about 1.7 times 2024 book value, which is a little bit higher than the 1.5 times, which is the historical norm. That being said, it's not uncommon to see the group trade above 2 times, particularly in an environment where rates are starting to help once again. I think what you need to see from the stocks as you get into the spring selling season is that the pullback in rates that we're talking about is actually having a tangential impact on demand, so order growth and also margins. So I think you need to see that translate into actual results. Now, there has been, bigger picture, there has been increasing discussion about the potential for the builders to garner a higher valuation over the longer term, just because their business models are so much stronger and more resilient, as we saw, you know, going through COVID and then through an 8% mortgage rate environment. I mean, debt on the balance sheet's historically low. They're generating a ton of cash, which they're buying back stock with. And there's an ongoing shift among the group led by some of the larger names like D.R. Horton and Lennar to an asset-light business model where they're controlling land through options rather than owning it outright. So it's a more capital efficient way to grow the business.
When I look at your notes on Lennar, for example, previously you've been saying how they've been sacrificing margin to drive stronger sales. At some point, they can stop using that as the shock buffer?
Well, we think we're going to continue to see financing incentives as we get into 2024. You guys asked the question, what is that rate where buyers start to come into the market more forcefully? And I think you hit the nail on the head at that 5 to 5.5% level. So builders are probably going to continue to buy down rates. The benefit to them now, with rates coming down to the 6.5% range, the cost of getting your buyer to 5.5 from 6.5 is a lot lower than it was back in October when rates were 8%. So we still do think that they're going to use that margin as a shock absorber. It's just not going to cost them as much as it would have a couple months ago.
How about the cost of goods sold in building a house like lumber? Because I know when the pandemic started and people started renovating like crazy, lumber went through the roof. Where are we now?
Yeah, lumber has come back to much more manageable levels for the builder, and it's been one of the key drivers of margins, actually helping to offset some of those financing incentives. Broadly speaking, the builder supply chains are in much better position than they were 6 to 12 months ago. Cycle times, which is the length of time it takes from the time you take a contract in until you deliver the house, are starting to normalize. Now, on the cost front, it's not that costs have come down. Sure, they have in some cases like lumber, which is a big piece of it, but it's more a situation where costs aren't rising as much. So there's a little bit more visibility for the builders in terms of their cost structure.
Absolutely fascinating time. The conundrums of supply and demand and whether or not we've rallied so hard into the end of this year. We really want to thank you, Drew Redding, for all your analysis when it comes to Bloomberg Intelligences across the board when it comes to these sorts of big builders. Meanwhile, I was almost taken aghast when we think how much house builders have rallied. 79% this year? I thought AI had stolen all the thunder. But no, it's been your home builders and Ozempic makers.
Exactly. It's just been extraordinary. I mean, people aren't selling their houses, so there's no supply. So if you want to move into a house, you got to go into a newly constructed one. And they're putting them up everywhere they can find land. And then it's just amazing. And now with interest rates coming down, even more so.
Certainly, people are still creating families. That doesn't go anywhere, and they're still needing to move up into slightly larger properties. Meanwhile, moving up, we're up about 0.2% on the S&P 500 as we speak. Look, that's just 10 points, and I might add, volumes pretty lousy. We're off by about 40%.
We're about 5 points away, literally, from the closing record high of 47.96, spot 56. Which was January 3rd of 2022.
Can we creep up there on these very thin volumes? Meanwhile, the NASDAQ 100 at a new record high. We're up 34 points on the NASDAQ itself, about 0.25% as well. And the Dow, actually, this is a bit of an everything rally, all apart from bonds today, but maybe seeing a little bit of weakening as we got yet more supply, this time a 7-year auction that happened about to happen at 1 o'clock. But we're up about, 2 to 3, 4 basis points, let's call it, across the curve.
Yep, absolutely. And on the commodity space, keeping an eye on global energy. WTI crude oil off 1.9%, $72.72. Again, maybe some of the tension easing in the Middle East here. So we'll have to see. We've spoken to a number of experts, and the traffic's still being rerouted. So we'll have to see how this plays out over the coming days and weeks. We'll have more coming up. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg TV Radio, Bloomberg Markets, we welcome. We are simulcast. Paul Sweeney and myself, Caroline Hyde, on a day where we once again crawl ever higher on the benchmarks. We were up just 0.2% on a day, Paul, but volumes, they are light. Nevertheless, as you said it, you've got that number in front of you. We're currently at 4,791 on the S&P 500. 4,796.56 is your closing record high, just above 4,800 for your intraday record high. So we keep an eye on some of those key numbers, but you've got to keep an eye on the record high that we've already hit on the NASDAQ 100. We're also still seeing a little bit of weakness across the board in the bond market as we anticipate what's happening now, that 7-year auction. We've had a flood of supply in the last week. Russell 2000 just off about 0.3%. Bitcoin, as you'll see, down a little lower. But it really has been an idea this week to just see how far we've come, the travel we've made, particularly in the last 2 months on the bond market.
Yes.
Best couple of months on record, right?
Yeah, I mean, you just think about the 10-year Treasury. We were just at 5%. Now, granted, it was only for about a cup of coffee, as Tom Keene would say, but we're down to 3.82 on the 10-year.
And it's record performance for corporate bonds, record performance for global debt as well. We're going to discuss it all with Robert Teeter. He's Civil Crest Asset Management. Great to have him joining the show, along with the one and only Jess Menton, who is our Bloomberg cross markets reporter. And Jess, I just go to you first for some of the superlatives, because you can become a little numb when you're quoting these numbers day in, day out. But it is extraordinary how we've had a bit of an everything rally of late.
It is. You look at the S&P 500 up close to about 25% this year. So this comes after its worst annual loss last year. It was about 19% loss in 2022. So that had been its worst annual loss since the 2008 financial crisis. When you look this year, this big bounce back, and then look over at the NASDAQ 100, what powered this year's rally? Obviously, when you're thinking about the Magnificent Seven stocks and other growth stocks, even other discretionary corners of the market, communication services, but obviously you do have those growth names that are housed in those sectors. But then not to forget also what's happened with small caps. Now, when you look at the Russell 2000 year to date, it's actually up about 16, 17% year to date, but a lot of those gains actually came in the last 2 months. So when you see that low from October, and they've been hit hard, particularly with small caps, but over the past 2 months, small caps up over 20%. But when you look at the Russell 2000 and you compare that relative to the S&P 500, it's still on pace for its worst 3-year stretch relative to large caps since the height of the dot-com bubble in the late 1990s. So you have a lot of people going into next year, Caroline, especially Tom Lee over at Fundstruck, making a big call on small caps, looking at the Russell 2000. He thinks it'll be a 50% gain, so that could make potentially 3,000 there for the Russell 2000. So big call there from Tom Lee.
Yep, absolutely. And Tom has been bullish. And,
we know, yeah, exactly. Perma bull there.
Yeah, he's a solid bull there, but he's kind of maybe just adjusting his call here to say, hey, let's look at the small caps. Could be interesting. Robert Teeter, the performance we've had, Robert, just in both the equities and the bond market, really since the end of October, it feels to some, maybe me, that the market's gotten a little ahead of itself here, maybe pulling some 2024 performance into this last quarter of 23. How do you think about that?
I think we're just on the edge of having come a bit too far, and I do agree that we've pulled a lot of next year's potential performance gains into this year. So if you look back partly over the last 2 years of just regaining, as you said, close to the highs on the S&P, not a lot has changed, and we've still got rates higher than they were previously. So from a multiple perspective and an earnings perspective, we've not made a lot of progress over those 2 years, but rates are a bit higher. So we could be a little bit ahead of things. The path ahead looks solid in terms of inflation continuing to come down, rates continuing to come down. So there could be some more room to go, but I do think we're going to have a bit of a lighter year next year on the basis of how quickly we've moved in the past 2 months here. And it's just been on the basis of the Fed changing their talk, changing their Fed speak, and giving folks a lot more optimism over the rate path for next year, which I think is well-founded. But again, with these compressed gains in the past 2 months, it sets the stage for a little bit of lighter gains next year.
Okay, so with your $31.2 billion of assets under management over there at Silvercrest, where, Robert, do you allocate from a bond versus equity perspective? Are you still thinking that a 60-40 works at this perspective? Have you been changing that up a little bit in terms of risk tolerance?
We've been pretty steady in being slightly overweight equities against that 60-40 benchmark. So about 5% over on equities, 65% to equities. And we continue there looking ahead. So I do think the earnings backdrop for next year looks okay. We've done some research that shows that when you're around 2% GDP growth, that tends to correlate with about 6% earnings gains. The street's at about 10 or 11% for next year. I think we're closer to that 6 or maybe 7%. But that's a pretty decent gain on the earnings side. And while I think it will take the full year, there is still a little bit of valuation recovery to be had, I think, for equities overall, and certainly a bit more for small caps.
Well, to your point, Robert, when you're looking at the NASDAQ 100 up close to about 55% year to date, how are you advising clients to specifically position when you are looking at equities? What are you telling them to buy? What are you telling them to sell?
Looking ahead into next year, we're looking to be very diversified. So I'm not in the camp that the Magnificent Seven is going to fall apart. I think from a fundamental perspective, they've really earned their way into the spot that they're in, contributing large earnings gains, having pretty solid earnings growth. So those multiples look okay to me. I think the market will continue to broaden out next year. I think those gains that we've seen in small cap outperforming a bit will continue next year. So it does seem to me that it's an environment where it's okay to be a little bit overweight equities, and it's one where you want to be diversified across equities.
So, Robert, I'm a little concerned about valuation, but maybe, maybe that's with rates coming down, maybe I shouldn't be as concerned, but I've seen the, S&P move 16, 17, 18% just in the past, couple of months here. I don't recall seeing earnings go up that much over that time period. So how do you think about earnings going into next year and valuation?
No, you're right. It's a great observation. I think it's been fascinating that this move has occurred outside of earnings season. So it really gives a clear window and makes it abundantly clear that the move has been on a valuation basis. I think it's been mostly justified with rates coming down 120 basis points in the past 2 months from 5 to 3.8 or so. But when you look ahead to next year, the question is, will we get more recovery, more rate reduction, more valuation recovery? I think a little bit. But it's very hard to make a case that we'll see another 120 basis point decline in the 10-year in the months ahead. So I do think from a valuation standpoint, we're close to fair value, and you really need to look to the earnings side for where gains will come from going forward.
Silvercrest, how US focused is it? Is it time to be looking abroad as well?
Well, there's always an argument to be made for looking abroad from a valuation standpoint. Unfortunately, that gap has not changed in quite some time. We do invest globally, although I do think that the valuations here in the U.S. and the earnings growth rates have been very compelling. As we've seen with the Magnificent Seven, there are a lot of innovative companies based here in the U.S. So we do invest globally. We're not overweight in terms of international equities. It's a struggle to see the catalyst for those valuation gaps recovering. At some point, I'm sure they will. So we're happy to find great companies abroad, but there's a lot of opportunities here in the U.S. as well.
Something I'm curious about, Robert, is how much, when it comes to the technicals, are you using in your strategy, and what do you think that's really telling us right now?
Well, I think, most times we do look at the technicals. I think the most important technical in the past 2 months has really just been the speed of recovery here with rates down and equities roaring higher very quickly. It's been interesting to look at some of the factors that have outperformed. And as you noted earlier, the recent acceleration in terms of small cap performance, I think, is very interesting and tells a lot of the story that might come next year, which is to say continued broadening of the market, more stocks participating in the advance. And I think that's based on solid fundamental reasons. So as much as there's a valuation argument to be made for rates coming down, the financial stress associated with higher rates hits particularly hard in the small cap space. And as that reverses itself and that financial stress eases a bit, those interest payments ease a bit, that puts a bit more of a tailwind behind the small cap space going forward.
It's an election year, 2024. How does that factor into your calculus?
Yes, so two of the metrics that we use in our valuation model are domestic policy and geopolitics. While the geopolitical side has, as you noted, settled down a little bit in the past few weeks, I think that the election year cycle will cause a bit more volatility than normal when we look ahead to next year. So the two things I've got my eye on for volatility next year, one is the election cycle in terms of just the rhetoric that goes around this cycle and what types of policies might be tossed about. And the second is really the Fed. So the Fed's made a lot of commentary that has been relatively dovish. They've been giving people confidence that we're past the peak. But there are a lot of open questions on timing and pace of potential rate cuts for next year. And so there will be a lot of interpretation of Fed speak. And so I think interpreting the politics and interpreting the Fed speak is likely to lead to a bit more volatility next year. We've got the VIX sitting here at a very low level. I think that's likely to change in 2024.
And Jess, you've got a great story out today just looking ahead to 2024, the 5 things to look out for in US stocks for the year. And interestingly, you do go global in that. It's notable on the day that we've got US dollar under significant pressure vis-a-vis the Japanese yen, for example, as we're finally anticipating some sort of rate move to the higher side from Japan. But talk to us a little bit about risks from abroad.
Well, more specifically, if you're looking at, say, for instance, Asia, the Bank of Japan is the last major central bank that still has negative rates, but that could change potentially next spring. So you have economists that have been polled by Bloomberg, and about close to 2/3 of them think they could be potentially the first rate hike for the Bank of Japan coming maybe in April. So that is a risk there, especially because a lot of those companies, and especially more of the electronic side of things, really got a big boost. If you look at the Nikkei this year, it's at a 3-decade high. And a lot of that has been on the back of the loser policy when you are thinking about the Bank of Japan. So looking at that, also obviously China's stimulus measures, because that was the big trade if you think back to a year ago and the reopening and all of that. But some of that stalled out when you look at some of those travel stocks. That'll be another big thing too. But then also looking at what's happening with Europe, when you think about the global central banks over there, a little bit of a different story if you're talking about the ECB and what's happening in the Eurozone versus what's going on in Britain in the inflation rate. At a particular point most of this year, the UK actually had the highest inflation rate of the G7 nations. But when you are looking at actually the latest CPI report, which came out about a week ago, now the inflation rate's a little bit more on par with the UK and France. But it's going to be harder for the Bank of England to begin cutting rates sooner than, say, if you are thinking about what's going to happen with the Federal Reserve, as well as the ECB. So a little bit of a tricky dynamics when you are looking a little bit more globally. But Japan and the Nikkei, a gangbuster year there. And then also in India, another really strong year there as far as winners globally in the stock market. Caroline.
Hey, Robert, earnings risk here. I'm looking at the S&P 500. It looks like analysts are looking for about 12% or so earnings growth next year. Any risk in that number, or how much risk in that number from your perspective?
I think that number seems a little bit high based on where economic growth is presently. So if you look at the New York Fed or Atlanta Fed models, we're just above 2% economic growth presently. When you think ahead to next year, my expectation is for around 2% earnings growth. Historically, that leads to around 6% on the earnings side. So in the past 30 years, there have been, I think, 11 instances of GDP growth between 1.5% and 2.5%. 9 of those 11 years, we've had positive earnings gains, and on average, about 6%. So that's what I'm looking for next year, somewhere in that 6% range. Analysts tend to start a bit on the high side. Those numbers tend to come down over time. I expect they will. I don't see a lot of earnings risk, but a little bit in terms of that 11, 12% number coming down to something more in the mid-single digits.
It's been so great catching up with you. Thank you for taking us really around the world and through every asset class. It is from Silvercrest Asset Management, the Chief Market Strategist there, Robert Teeter. And we thank Jess Menton as well for taking us around the world with her always all-encompassing reporting. We thank you. Meanwhile, look, we've got plenty more to be digesting when it comes to, well, some alternative assets as well, maybe, Paul. Kathy Wood was on surveillance a little bit earlier with Carol Massa and Manus Cranny, Katie Greifeld. Kathy Wood seems to be, once again, going into Bitcoin futures ETF, really thinking that that date is coming closer. They've, of course, put out, and ARK has its own bid for an ETF, but she doesn't seem to be going along the grayscale element of things.
No, making some, I mean, still keeping the long exposure to Bitcoin, but kind of mixing up a little bit some of their investments on the board here. So it's interesting to see kind of where she is going here, because again, the ARK family of funds is all about disruption around the economy, including financial technology.
We'll have so much more coming from Kathy Wood. You do not want to miss some of that conversation that she had a little bit earlier on Bloomberg. We are simulcasting across TV and radio for you today, December the 28th. Stick with us. This is Bloomberg.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We welcome you to Bloomberg TV Radio, our audiences worldwide too, Paul Sweeney and Caroline Hyde, as we digest what is, well, the second to last day of trading, where we still managed to claw a little bit higher across the markets. But we want to dig into the world of ETFs now, and not the active management side of the equation, Paul, because we're going to be hearing from one Kathy Wood, and they have really performed. In particular, the innovation ETF is up, last time I checked, I mean, 73% on the year.
Absolutely.
Look, compared to 2020, when it roared 150% higher, it's still off. But what's notable is some great BI analysis, and I know you're a strong lover of Bloomberg Intelligence. But actually, even though we're seeing more active management funds gaining share among the theme of ETFs and more being launched than being closed, it seems as though actually money is coming out of those funds in terms of fund flows.
Yeah, looking at this, the top 5 holding in Kathy Wood's flagship ETF are Coinbase, Roku, UPath, Tesla, and Zoom. and they represent over 40% of the fund's weight. I mean, talk about concentration risk. That's what you get amongst other attributes with Cathie Wood's ETFs. And I'm just putting up the ARK Innovation ETF Fund just over the last 5 years. I mean, it peaked back in, let's call it, February of 2021 at $156. Here we are today at $54. So lost a tremendous amount of value, although it is up year to date very nicely. So, but it's just amazing the volatility you see in that. But that's what you sign up for. That's the risk you sign up for, because
that's innovation.
Risk return, exactly. Risk return, highly concentrated bets, lots and lots of winners for her.
And interestingly,
Tesla.
of course, she dialed back from NVIDIA in particular when the rest of the market was plowing into that stock. She was in NVIDIA before NVIDIA was cool, but then she felt that it was too much of an obvious holding. That's why she likes the kind of AI themes that UiPath has. Yep. Let's listen to Cathie Wood. She was on the shows a little bit earlier. Just take a listen from ARK.
Bitcoin as we ever have been. But there are a few regulatory and tax uncertainties, and we had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally, and now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk.
And I mean, let's get a little bit specific here, because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
But you've talked about January 10th, Cathie, I think in another report. Is that possible, whether it's you or somebody else, in terms of the first spot Bitcoin ETF actually getting approval?
Well, we think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try, dogged and determined. And so here we are. We think we're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us, it's others as well. We think a number of funds could be approved at the same time. And they've been asking not only one set of questions, but follow-up questions. And again, that's a very good sign.
Well, speaking of engagement, go ahead, please. No,
Yeah,
finish.
the last few questions have been very technical. And so more de rigueur, and you'd expect them to be asking these questions as we head toward an approval. Now, it's not 100% certain, and so we want to make that clear as well. This is the SEC, and we never know, what might happen along the way.
Regulators can be tricky, that's for sure. Hey, listen, you mentioned engagement. Let's talk about engagement with your funds overall, and especially the ARC Innovation Fund. Up 72% year to date, easily outperforming some of the major market benchmarks. Still down 65% from the high back in February of 2021. For you, though, a lot of critics. We bring up your name, we bring up ARC, and you have a lot of fans and you have a lot of critics. There's a lot of discussion. Does it feel, though, a little bit like a victory lap this year?
Well, we are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22, as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. And we would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape, because we are very, our companies thrive on deflation. Technologically enabled innovation is deflationary.
So, Kathy, a very good morning to you. It's Manus, first time we've met on. So we're going to move to a deflationary environment. We'll come back to the big macro call in a moment. Just let's square it away before I talk to you about the flows in the funds, which is how much interest rate cuts do you presume are you forecasting? Leave the forecast of everybody else aside. What do you presume will happen next year?
Well, we put up a chart in one of our in the Nose, which is a YouTube video that I do every month, Employment Friday, and in that chart you will find a ratio. It's the metals to gold ratio. So metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November, and what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years, and interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation.
All right, that was ARC's Kathy Wood speaking to Bloomberg Television earlier today, talking about the crypto space. They are still exposed, still long crypto, but they changed up some of their holdings in the space, so it was good to get an update there. S&P 500, we are up, call it 0.2%. We're going to have more coming up. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
All right, here we go. Bloomberg Markets, Caroline, hi, Paul Sweeney. We are simulcasting live from the Bloomberg radio studio in New York City. How about that? S&P 500 up about 0.1% of 1%. That goes for the Dow. That goes for the NASDAQ. All up about 0.1% of 1%. And then the S&P 47.88. Remember, 47.96 is the record close, so we're getting close to that. That's for sure. Yields, looking at the 10-year Treasury, up about 6 basis points, 3.85% on your 10-year. In the commodity space, oil rolling over here off about 2.4% towards the low of the day, $72.35 here. And Bitcoin, which we're going to get to during this block in size, off about 1.9% here, 42,000, let's call it 600 for Bitcoin there, Caroline.
Yeah, and maybe that's why we're seeing Riot platforms on the downside today. We're seeing Marathon Digital also on the downside. Maybe they're more of the proxies of what's happening in the world of Bitcoin. Let's talk about Bitcoin, about ETH, about some of the altcoins as well, with David Pan joining us from Bloomberg News. And really it has been, along with the everything rally across bonds and stocks, a particularly good end of the year to Bitcoin as well, it feels like. So much of it is around the ETF, or are there more fundamental drivers than that, David?
Yeah, so recently we've seen a decline in Bitcoin prices. A lot of the traders regard it as a healthy pullback from the earlier surge. So, the ETF news has been around for quite a while this year. So a lot of people are wondering if, the news has been priced in the token prices. We've seen a lot of leverage long positions recently. So, the pullback could be a result of traders hedging against their leveraged long positions they built up earlier. So that's that's one of the latest trends we're seeing in trading.
How much in trading, just broadly defining crypto, and I know most of it's in Bitcoin, but how much is retail versus institution? Do we know that?
Yeah, we have seen a significant shift from retail to institutional investors recently. In the early days of Bitcoin and Ethereum, we've seen mostly the prices were mostly driven by retail traders, but now we're seeing influx of institutional investors like hedge funds, asset managers coming in. So I would say right now we're seeing more like a surge among institutional investors.
David Pan with a setup there on all things Bitcoin and ETH. We thank him so much for it. And let's keep digging into this particular area. We're pleased to welcome from K33 Research, Vetle Lunder. He's a crypto market analyst and really thinking, Vetle, at this moment about the institutional flows. I feel like since 2020, we've been talking about institutions getting into crypto. Is the ETF, the spot Bitcoin ETF, what brings that to its head? Or does the regulation need to become more clear before really we see the institutions take up and adopt this asset class?
It depends on like what you mean by stating institutions. So even in 2020, after COVID, we saw an influx in trading activity from typical regulated markets, for instance, CME. But if you just segue and differentiate these traders with actual institutional launches. 2023 and 2020 is night and day. We had professional traders entering in 2020, whereas the last year has seen more or less all financial institutions dabble into Bitcoin in some way, either by launching Bitcoin ETF filings or by launching crypto custody or through other means. So it's definitely been a run-up in institutional activity throughout the year, and it's night and day compared to what it was back in the 2020 and 2021 bull market. And also alongside this, regulations are gradually becoming more clear, in particular here in Europe, where we have MiCA, but enforcement is different across jurisdictions, but an ETF approval in the US would likely offset a lot of this regulatory unclarity.
So, Vedli, give us a sense. I'm not sure if we know this that well, but how much of crypto trading broadly defined or ownership broadly defined, where is it geographically around the world? Where is it more developed? The US, Europe, where do we see it?
It's definitely more developed both in the US and in Asia than in Europe. Both markets are bigger for Bitcoin, and a lot of the older holders and most influential early adopters originates from Asia, whereas the US more or less took over the relay pin after 2020 with a lot of activity developing there. You can see it in the hash rate, where a majority of Bitcoin's mining power is in the US. And you can also see it on exchange balances, and also now even in futures market, where CME, despite all its limitations in terms of who can access CME, is the biggest Bitcoin market. So it's definitely been a rotation towards US markets, making US markets the most influential and important market for crypto as a whole.
So Vedli, I'm just, I'm an old school stocks, bonds, commodities, that kind of thing, currencies. So when I think about the exchanges and some of the problems that we had with, FTX and Binance and things like that, how does the market participants like yourself kind of view that? Is that just a growing pain for a new asset class, or does it show underlying problems with this asset?
All of the above. Okay. It is definitely growing pain. Crypto, particularly in 2020 and 2021, was viewed as this exuberant source of wealth that all VC funds wanted to invest in. Risk was not something that a majority of the market cared about. So that allowed nefarious businesses such as FTX and Three Arrows Capital's untransparent loans to develop. But this was enabled by crypto being purely peer-to-peer, allowing people to send money wherever they want. And it's a natural by-effect of that very powerful and important attribute of crypto. But it's also due to regulations not having been completely clear at the time.
They're still not, Vedli.
No, they aren't. By no means. But we have clarity regarding a path onwards, in particular in the EU and in Singapore. And there are developments and a lot of discussions happening elsewhere. And it's also been 2022 was a proper reminder for everyone involved in crypto that it's very costly to put your trust into someone else, exposing the frauds of FTX and also all the dangers associated with all the lending platforms. So we can only hope that the market, in addition to regulations and consequences of these actions, having improved and traders having learned.
Has it driven innovation off the US shores? Are we seeing startups, crypto startups, deciding they do want to be based elsewhere because of the pendulum swinging towards regulation and regulation that they feel might stifle growth?
We are seeing some signs of it, at least some businesses flagging out to the Middle East, but it's not that present. I think it's a bit over-exaggerated, and it's very clear that the majority of the influence from capital markets will still remain in the US. And also it's in the US where the deepest VC pockets are based, and it's also where the major opportunities are in terms of penetration of your user base. So while it has somewhat moved on to other areas, the US remains very, very relevant.
So, Vetle, just can you explain to me what halving is? I mean, am I saying that right, Caroline?
Halving, yeah.
Halving,
Or depending
yes.
on whether you're
Halving.
British or
Yeah,
American.
what does that mean?
Yeah, do you want me to just explain it from
Yeah,
from
just
the
give me
bottom?
30 seconds on what I need to know about that, so in case somebody asks me at a cocktail party.
Okay, so each and every day, approximately 900 Bitcoins are produced today. And in 4 months, the amount of daily issuance of Bitcoins will be reduced by 450 Bitcoins, meaning that only 450 Bitcoins will be produced every day. Each and every 4 years, this number of daily issuance of Bitcoins are halved. And in the end, Bitcoin's ultimate supply will converge at 21 million. So it's a deflationary supply shock hitting Bitcoin every 4th year.
All right, very good. I'm learning something new there. Now I can go. I can give you 10 seconds on that if somebody at a cocktail party comes up to me. Vetle Lunde, thank you so much for joining us. Vetle Lunde, senior analyst covering all things crypto for us, and we appreciate getting some of his time now. Staying with our technology take, Wedbush Securities senior equity analyst Dan Ives thinks Apple could reach $4 trillion market cap by the end of next year and doesn't see the potential Apple Watch ban having a major impact on the company's growth. He spoke on Bloomberg Surveillance.
We're talking less than 1% of disruption from Apple Watch, in terms of in the actual quarter. And I think, look, it just speaks to they're going to have patent issues like this on healthcare, but there's a renaissance of growth on iPhone units, services, double digits. And that's why I think a lot of the bears right now, they're deep in those caves in hibernation mode. I think a year from now, we have a $4 trillion market cap on Apple.
You say the bears had a great fictional story, okay?
A Netflix fictional.
A Netflix fictional story. We all want to be in it.
Not Apple Plus?
I gotta hand it to you. This shirt just screams, full of confidence, full of vigor. But you look at the China story. So make sense of this for us. How do you get to $4 trillion when you still got the government pushing back against Apple products? It was a headline just in December. I mean, is that myth or is that a headwind?
I think it's a headwind, and ultimately my view in terms of China is that I'm not saying it's roses and champagne in Beijing with Apple, but we are seeing growth, and that's something we've seen come out of Asia checks even over the last week, because you have 100 million iPhones in China in a window of an upgrade opportunity. As those upgrade, and look, for Huawei, it's a good phone, but realistically, it's an iPhone 12. I'm saying from an actual functionality perspective. So I do think that it's a headwind they have to contend with, but it is the hearts and lungs of the Apple story. And that's why a lot of the bears at 500 billion, a trillion, trillion and a half, 2 trillion.
Well, they're whipped now, aren't they?
It's all about the China.
3 trillion now.
It's all 3 trillion, I think, going to 4 trillion. It's always about that big bad wolf, the China story. And the actuality, China has actually been fueling the engine.
Well, let's talk about what the bears are saying right now, because they're saying, you think about in terms of the product lineup, that Apple really hasn't had a hit since the AirPods, and that was all the way back in 2016. So you talk about this new growth, but from the product lineup, where is that going to come from?
Well, first off, the install base, it's unparalleled. It's the best install base in the world. So just from an install base perspective, you have 250 million iPhones in a window of an upgrade opportunity. I think that's why iPhone 15 so far, Christmas came early, a strong holiday season. But for 2024, and Gurman's talked about this as well, I believe you're going to have not just new phones that come out from an iPhone 16, but we believe you're going to have the iPhone App Store, which is going to be an AI app store focused on AI apps. That's going to be something that's going to be incremental for services. And I think that's very important. You combine it with Vision Pro, and we believe more and more products coming out, they flex the muscles.
I do want to switch gears here and talk about EV demand, because this has been one of the stories that's really emerged. That it just feels like all of these automakers really miscalculated how much demand there would be for EVs, and now you're seeing those production targets get cut. How does that factor into how you're thinking about Tesla? Is that a bear case for Tesla, or does Tesla just command more of maybe a shrinking pie?
Yeah, Kate, I think that's a great point. Look, right now it's Tesla's world, everyone else paying rent when it comes to electric vehicles. And I think they're doubling down. You look what's happened in Detroit, GM, Ford actually peeling back a little from electric vehicles, some of the foreign automakers. Look, demand's definitely softened. Price wars have come through, but a lot of those storms have now passed. I think for Tesla specifically, unit volume looks strong in China. I think this is going to be a record quarter for China, in terms of Q4. You go into next year, I think demand actually starts to accelerate a bit relative to where people thought. I think for the overall industry, it's still a massive transformation, but now you're starting to maybe peel back a bit in terms of, okay, this is not going to 40% penetration, maybe it's 25, 30.
The one and only flamboyantly dressed Dan Ives. For those radio listeners, you didn't quite see the joyous shirt that he was wearing in that particular segment this morning. But once again, he's raising those price targets on Microsoft. I think he was joining Bloomberg yesterday. In fact, my producer whispers lovingly in my ear. Meanwhile, we've got so much more to be discussing across the markets. Stick with us, Bloomberg TV and radio simulcasting with Paul Sweeney and Caroline Hyde.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Short-term funding markets, let's talk about that. We're going to do that because we do that at Bloomberg Markets. Caroline Hyde, Paul Sweeney, we're here simulcasting from the Bloomberg Radio studio, so that's kind of a fun thing to do here. Alex Harris joined us, Bloomberg News. Alex, it seemed like 5 years ago we were talking to you almost every day. Explain why we were doing that and why maybe this time maybe a little bit similar?
The conditions are kind of, I guess, Paul, sort of similar in the sense that, you have the Fed still removing liquidity from the market via quantitative tightening. Same thing was happening 5 years ago. I think that was when Jerome Powell made the comment at the December FOMC that their QT was on autopilot and the equities market and all the markets kind of swooned, and then they backpedaled in January. But was really notable at that point that it was really one of the first signs for the funding markets in general, and we're talking the plumbing of the financial system, to say, hey, wait a minute, something's not right here. We're looking a little off. The banks are telling us they don't have enough balance sheet, that they just had to pull back more than expected. I mean, and that sent rates from the time, they were 2.25%, 2.5% for an overnight rate covering the end of the year. And they spiked to 6%. And I remember people being like, I have no idea what's going on. I cannot believe this happened. And while we're not seeing that significant of a move yet, we are definitely seeing more volatility at the end of the year. And it's making people a little bit nervous here, because you're starting to think about those things about 2018 and trying to understand, well, what's the situation really with the Fed's quantitative tightening tightening program. Are reserves actually a bit more scarce than people are thinking? And does the Fed actually have to stop QT sooner rather than later? And these are all questions I think people are going to be asking themselves in 2024.
So what would be the catalyst, or indeed what would be something that gets your attention if that suddenly you're like, okay, no, here we are, we're back, this is how it felt in 2018?
I think if you see more intraday moves in some of these other short-term rates, everyone talks about the Fed funds rate because obviously it's the Fed's target rate, and that was moving quite a bit in 2018, 2019, forcing the Fed to kind of come in and make adjustments to its what they call administered rates, or we call their tools, to try and maintain control. But I think what worries me more is the secured overnight financing rate, or SOFR, because now
that's a new one.
it's basically it was the heir apparent to LIBOR. So
yes,
LIBOR
I grew up
was
with LIBOR.
Yeah. So SOFR
take London out of there.
So SOFR is tied to the repo market, and there's a lot of transactions underlying that rate, but as things get more scarce, that rate gets more volatile because the markets are basically all government securities backed. It's all secured funding now. So I'm looking more for volatility in the SOFR rate. And today we matched an all-time high, 5.39%. I expect that when that print comes out tomorrow morning, we're going to be at another all-time high.
Why does it? I have the graph up there for the year for the SOFR rate, or it goes back, for the last year. It's stair steps. Why does that happen?
The stair steps reflect rate hikes.
Okay.
So it moves in tandem.
Right in tandem
So
with rate hikes. Okay.
so it moves in tandem. But now it's not. It's actually more volatile intraday because
that's what I'm looking at.
It's a combination of you have a lot more treasuries in the market. And so those are a lot more treasuries that need to be financed. And so that pushes your funding costs higher. And so that's another concern here. There's a lot of supply, and there's a lot of people buying treasuries now and need to finance those positions. Things are getting expensive. And I think that's also what's pushing on the market here, is that this rally comes, there's a cost to this rally in treasuries. And if you're trying to finance those securities and you're trying to go out and borrow those securities, it comes at a cost, and the cost is higher funding rates. And that's something that everyone's going to have to grapple with if you continue to price in, more Fed rate cuts, a more recession. These are all things that need to be considered when we're looking at these markets next year.
Is the Fed starting to talk about this? Are we back to financial instability discussions?
The minutes haven't touched on it too much. Jerome Powell has made some comments in the press conferences. I think the hope from market participants is that the comments would go farther, or the questions would go farther and be a little bit more probing. I'd like
Come on, journalists, do your job in that room.
But I'd like to see what the minutes start to say and what the minutes start to show, because I think these things do matter. And remember, there was a bit of a disruption at the end of November, beginning of December. So that was before the last Fed meeting. So I'd like to see maybe some reflection on that and what they think is actually going on here, and maybe more discussion on reserves and their part and quantitative tightening, because I think that policymakers are starting to come around to this idea that if they start cutting rates, they can't do quantitative tightening at the same time. I think the communication is just going to be too difficult.
Now, you were making the comment to us before we just went on air that when you're going around to some of the trading desks on the street, some of the senior folks are in.
They're in
and this is this week, typically a week they wouldn't be in. So what's the concern then?
When I see that they're all here, I mean, obviously, it's their job and this is what they do. But if
this is the week they take off.
They usually just leave it to the junior guys to handle. At least that's been my experience when I've talked to them at previous year ends, and they're all here, which is kind of like, they're expecting some volatility. They need to be able to manage this and to be able to manage it confidently. I mean, I woke up this morning and checked in. I mean, for just to get financing from December 29th to January 2nd, the rate was like 5.7%.
And where had it been, I don't know, a month ago?
I mean, I talked to people 2 weeks ago who were getting finance for the turn of the year at 5.56, and they're like, I might lose money on this, but at the same time, they're like, no, at least I'm protected. At least I know I've got my funding and I'm set.
Where do I get this funding from?
You got called the repo brokers.
Okay.
But Alex, to that point, like, you're going home to your family after this. How do you explain to them round the table what this has a real impact on them sat at home? How we will feel this sort of volatility and tightening from a layman's perspective?
If if I tell my 3.5-year-old, she just gets very excited about is the rate going higher. So I think she's just
more.
Yeah, I think she's just rooting for chaos. But, you know, I talk to my husband and, you know, I'll talk more about treasury yields and I'll talk about, you know, I talk about in terms of flows. I talk about in terms of deposits. You know, those were a lot of discussions we were having because he would be like, well, why is my account at, you know, this bank not paying me anything? Yeah. And I, you know, would explain to him. And then I kind of explain the knock-on effects and how that, you know, how I look at things. So that's how I talk about it with him is talking about it in terms of deposit rates, in terms of cash flows, you know, money market funds versus deposits, you know, bank deposit accounts versus CDs, things like that. And that's how I kind of
But it's still safe to say for this layman person like myself who has no idea about that part of the market, the short-term money markets, repo markets, they're working fine these days.
They are. They're just more volatile.
They're just more volatile.
That's just something for people to pay attention to because, you know, it's sort of like one of these things. I mean, you think back to what happened in September 2019 where we were looking at, you know, 10% on an overnight repo rate. You know, it's sort of like a little bit and then all at once. And I think that's what makes people nervous when you start to see the volatility. So people watch these things very closely because if there's any frictions in the financial system, you know, there's a lot tied to it. Look, the basis trade, which we've talked about a lot this year, is tied to the repo market. Okay. Hedge funds.
In 10 seconds, what's the basis trade?
It's where you're taking one position in the futures market and then you're positioning against that in the cash market. Okay. So you have, you know, if you're short futures, you're long cash treasuries, and that gets financed in the repo market. That trade has continued to grow. So if there's frictions in the repo market, that becomes a very costly trade for those hedge funds. And so now you're looking at, you know, market moves that do affect it because of where repo rates are trading.
All right, Alex Harris, go-to source on the short-term government markets, money markets, repos, all that stuff. That I didn't pay attention to during that class in business school. I have to be honest with you. I'm like, I'm going to be an equity guy. I'm going to go ahead and sell stocks, do some IPOs, maybe throw in a high yield deal every once in a while. I don't need to know the money market business. Alex
Who
Harris
knew
does.
at cocktail parties you needed to know about the repo market?
Exactly. Well, yeah, I still quote LIBOR because that's kind of all the loans we did with LIBOR plus, you know, a nice spread. So anyway, we got 4788 is your S&P 500 level. So, you know, still about 10 points below that record. So.
Still a couple more hours.
We're gonna stay on that watch, and we got one more trading day. So we'll see how it goes.
Can we eclipse it? Then can we claw our way on these very thin volumes? We're down about 40% on volumes more generally on the S&P, similar for the Nasdaq, but good old Nasdaq 100 still managing to plow on into new record highs.
Yeah, WTI crude here definitely pulling back off some of the concern we had earlier in the week, late last week from the Red Sea. We're off about 2.9% on WTI crude oil, just under $72 per barrel. So we'll keep an eye on that. That
some inventory build up here in the U.S.
Exactly, right? Exactly. I could never be an oil trader. That thing whips around all over the place. I have no idea how that works.
Stick to your equities
exactly.
knitting.
I just go out there and tell a story, and it all works. If it goes up, great. If it doesn't, too bad. All right, we're gonna have more coming up. This is Bloomberg.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that if that time was there, sure, we could go public.
This is Bloomberg.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
For TV and radio worldwide, welcome to Bloomberg Markets. I'm Shonali Basak alongside Bonnie Quinn, and what a day we have on our hands here. A lot of green on the screen, actually quite exciting. When you look at a lot of the indices, we are looking at or near record highs, Bonnie.
I think it's fair to say that that collapse that many were calling for didn't happen. I mean, I know we have a couple of trading days left, the rest of today and tomorrow, but we are seeing those indices inch towards those records, Shonali, and some of them making those records, as you pointed out earlier. Just to look at the S&P 500, never short a dull market, and that's certainly playing out today because we're up another 8 points, 47.89. Not quite at that record yet. We do have about 7 points to go. Will we make it today, tomorrow, or will it have to be 2024? I don't know, but I think we're going to get there. There is a little bit of profit taking in treasuries today, 384.99. Also a little concern in repo markets, and that's very well reflected, I think, in today's action. We also had a 7-year auction that was a little bit disappointing, and that's also playing into today's action. Crude oil. So we got inventories, and they were more than expected, but not in Cushing. In Cushing, less than expected, and that's sort of playing into the mixed dynamic that we have in oil markets. But certainly WTI coming off of the highs. That's 2 days of declines now. 72.07, just above 72. The Fed won't be displeased. That definitely helps the disinflation narrative. And then Bitcoin is also giving back some of yesterday's gains, down about 2%. Plenty of Bitcoin news today, too.
So certainly not green everywhere on the screen. I want to talk more about those indices as well that have already hit records today. What's remarkable here is that the SOX Semiconductor Index earlier in the day hit a fresh record. The NASDAQ 100 as well. Let's see where we end the week as well. The NASDAQ Composite also still up 0.1%. The Dow Jones Industrial Average, another index that did draw a fresh record earlier today, Bonnie. And I bet you, I think a peppermint coffee that the S&P 500 will notch a new record by the end of the week. Though you think it won't get there till next week.
I like anticipation. I'm thinking maybe Tuesday.
Well, let's see what our next...
Something to come in for in the new year, right? But also, so you say a peppermint hot chocolate?
A peppermint hot chocolate, I will bet you that. Maybe something stronger. If if it gets to it. But, you know, that would be the end of the Santa Claus rally into next week. And let's talk about exactly when our next guest thinks that we'll hit that new record. That is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Now, the question about the S&P hitting a fresh record is, does it maintain that record or does it lead to a fresh sell-off?
And Shonali, I think that is the key question. Obviously, we've had a tremendous amount of momentum that has really led this market to its new high, whether it's this week or next week, whichever one it is, it will probably hit that new high. You've had a broadening out of the market as small caps and mid caps have done better. They've actually outperformed the large caps over the last couple of weeks, and sentiment is strong. So you've had this momentum play going, and I think it will continue in the near term. What concerns me, though, is once we get into the first quarter of next year, a lot of those momentum elements, I think, are going to start to fade away. I think you're going to have the consumer start to pull back a little bit. I think you're going to have some concerns around earnings. Earnings starts around the second week of January in earnest, and the few companies that have reported already for fourth quarter, they have missed on revenues, a majority of them. So I think there's going to be some concern around earnings, and I think there's going to have to be some kind of meeting in the middle between the Fed and the market on what rate cuts are going to look like. That will probably happen during the first quarter as well, and I think the market will have to reprice. So I would expect some volatility and maybe a little bit of a pullback in the first quarter, first half of the year.
And I've made myself a big mistake by promising Vania a peppermint latte. Now I owe about 20 team members one as well if we hit a new record tomorrow. But you know, something about the S&P's record that I wonder about, the fact that we've seen all these other indices already reach records today. Do you think many investors are starting to discount the breadth of the markets here and the opportunities that are outside what we've seen the Magnificent Seven and other kind of classic stocks we've been talking about all year?
Yeah, I think for a while, investors have been looking outside of that Magnificent Seven, looking to see where else they can put money to work because there had been such a strong run there. And we did see those names pull back over the last quarter or so relative to the rest of the market. So people have been looking for other places. Small caps and mid caps, as you mentioned, is a place that people have looked. But I think you could also look in sectors that have been beaten down a little bit. We're not digging for trash by any stretch of the imagination. We're looking for high quality companies that have solid balance sheets, good cash flows, but have been pulled down by the market. There's names in the financial sector. I think you can get some names in the healthcare sector as well. And people are starting to add those to their portfolios, especially here at year-end, Shonali. We had, what, $6 trillion in money market? And over the last few weeks, we've seen quite a bit of outflows out of money markets and into ETFs. So I think people are trying to get into the market before the end of the year as they anticipated this Santa Claus rally to continue.
So, Victoria, I hear what you're saying about the U.S. consumer. I think it's become a little bit consensus that the consumer is starting to fade. Neil Dutta, though, is one that's not buying it. He says, look, real incomes are climbing and therefore the consumer will be resilient. Are we underestimating the resilience of the U.S. consumer?
So, Vani, I always say, and when I'm talking to my clients, I say never underestimate the U.S. consumer. So I don't want to say that they're going to completely pull back, but I think they will start to slow down, not just because they're coming out of the holiday season, not just because prices are higher. I mean, I understand we have the disinflation component, but if you look compared to 2 years ago, food costs are 32% higher, right? Insurance is 34% higher. They're paying much more. And even if you take mortgage interest out of the equation, the interest component for the average consumer is 50% higher than it was a year ago. So they are getting hit, and we're seeing delinquencies go higher on credit cards, on auto loans, student loan payments are coming back into play. So I think there's quite a few elements that will cause the consumer to take pause. And the one other element that I think we need to look at is that we believe that as pricing power diminishes for these corporations as we go through next year because inflation's coming down, but wages are staying higher, that's going to cause corporations to cut costs. And we know that leads to layoffs. We've already seen quite a few companies come out and start announcing layoffs. That's going to hurt the consumer as a whole, especially those in the lower income brackets.
Victoria, I know you like some of the financials, Visa, MasterCard among them, and also some of the insurance companies, but is it a little too early to be getting in?
Well, I think if you look where those names have come over the last year, they're down pretty significantly. And so you can go ahead and start adding a little bit. I would never just do a full position all at once and jump in with both feet. Take baby steps and do a little bit. You can dollar cost average into some of these names, but I would go ahead and maybe wait for a down day and add a little bit to your portfolio. You know, we say trim on the green days and add on the red days. So that's how I would start to go in to some of these names and just look at it over the next quarter or so and be opportunistic with them.
How do you think about the relationship to the interest rate story? We've seen just a tremendous drop-off in yields this week alone, but there are a lot of questions about the direction of travel next year. How sensitive is the market to any rise at this point? Not rate hikes necessarily, but rise in the level of yields we're seeing now.
Yeah, I mean, obviously there's certain parts of the market that are more sensitive than others. And we see that as we, see the volatility in the fixed income market. But I think we actually will see yields move a little bit higher in the first part of next year. I mentioned I think the market will be repricing. The market's pricing in 6 rate cuts. So as some of that comes out of the market, I think we'll see yields go a little bit higher. And so I think there'll be a little bit of a reaction to that. Do I think we're going back up to 5%? No. So I don't think we're going to see the same type of reaction that we saw a few months back. But I think it just means there's going to be continued volatility. I would add duration in your fixed income portfolios because over the course of the next year, I think yields will probably end up lower, but it's going to be not a straight line down. I think we'll go up a little bit and then come back down as the Fed and the market come to terms.
Speaking of the market coming to terms, soon after we end the Santa Claus rally, it's only a couple of weeks away from another very busy set of earnings. I know I'm already preparing for them. You were talking about the consumer and the uncertainty there. How much do you think that will feed through into what we're seeing in corporate margins?
Yeah, I think we've already started to see a little bit of it. If you look at what the expectations are, they've come down about 6% from the beginning of this quarter from where they were previously. So we're already starting to lower the bar a little bit for this earnings season. And I think we're going to continue to do that. As I've mentioned, some of the early reporters were not as strong as expected. We've already heard about layoffs that are coming. I think we'll continue to hear about margin pressure, about pricing power. I think these are elements that are going to continue to be part of the story in earnings. And look, the New York Fed, their global supply chain pressure index is actually moving higher. So it could be that costs on the supply chains are going to start increasing again. That is the exact opposite, I think, of what the market's expecting, or even what maybe the Fed is expecting. And goods prices should start to settle a little bit. I don't think we're going to continue to see them decline. So these are all elements that I think are risks for earnings. And I certainly don't think we'll hit that 11, 12% target in EPS growth that people are expecting.
Victoria, does disinflation continue throughout next year, or is there a chance, what is the chance, that inflation rears its head again?
Yeah, so Vonnie, I would say that overall, yes, we'll continue to see some disinflation. Do we get down to the Fed's 2% target? No. I think we probably settle somewhere right around a 3% level, maybe a little below 3%. But I also don't think it's going to be a steady decline. There's a lot of elements that are adding to this inflation pressure. It's not just shelter costs that a lot of people are focusing on, or gasoline on the headline number. Healthcare costs, insurance costs. I just talked about the supply chain costs going higher. Look at the regional Fed surveys that came out this last month. New orders were down tremendously and prices were up. And that's usually a precursor to inflation. So I think there's some pressure that's there that maybe we don't every month continue to come down. It could be a little bit rocky, but over the course of the year, we'll see the disinflation component continue, just not down to that 2% level.
Okay, so you mentioned some of the financials, also insurance companies. Can you give us a few more areas where there might be some opportunities?
Well, I just think you have to be extremely cautious here, Vonnie. And I would say there's not one sector in particular that I would say go all in on. I think do your homework, look at those companies that I mentioned earlier that have strong balance sheets, good business plans. They have the cash flow that's there. Those are the things that we're looking at. I also think you need to add a little bit to your fixed income allocation. I would use some options in your portfolio in order to generate extra income. People are going to be looking for cash flow in order to buffer volatility. You can use options or alternatives as a way to do that. And a long short portfolio, I think that's an opportunistic way to play some of the volatility that we're going to see in the market as well.
All right, Victoria, thank you so much for joining us today. That is Victoria Fernandez of Crossmark Global Investments. Some wise decision making there, Shonali, but it's really interesting. Even though volume is down, I feel like there are people very much participating in this market today. You can see the pockets of activity.
You know what somebody told me yesterday? They're like, you're discounting how many people are sitting at home, watching Bloomberg television, day trading today. But that too. You know, selling right now, to your point, is a less attractive proposition when you think about the tax implications. So the 2024 setup, you can't confuse what we're seeing today for what can be expected next year.
Exactly. Well, coming up, we're going to be speaking with Andrew Sliman. He is lead senior portfolio manager at Morgan Stanley Investment Management. We're going to ask him about this rally and whether it continues. He says yes. Others at Morgan Stanley might disagree. So we're going to have that debate on whether the Bulls or the Bears will win out in 2024. That's coming up, and plenty more as well. We're also on record S&P watch. We're up 25% this year for the S&P 500. That might please many, but for those looking for a record, we're about 6 points away. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg Markets. I'm Bonnie Quinn, along with Shonali Basak, for all our radio and TV listeners worldwide. Joining us now is Andrew Sliman. He's lead senior portfolio manager at Morgan Stanley Investment Management. So, Andrew, do we make it to a record high on the S&P today, tomorrow, or does it wait till next year?
It's incredible, right? The peak 47.96 was January 2nd, 2 years ago, and here we are. A day or two within 2 years. I think we might break it tomorrow. I think the market might push high. I don't see a lot of selling resistance. And look, my view is you can't ignore the breadth statistics. You have 90% of the largest 1,500 stocks trading above their 50-day. That is incredibly bullish sign. To stay bearish, I think, is really ignoring history, ignoring statistics. I think the market pushes higher.
So, Andrew, that was the fun question. But honestly, investors who have missed this rally are going to have a difficult time choosing what to do, right? And I know you point out that emotionally it's very, very difficult. Do you get into something that's already at a record? Or do you choose a laggard here? Because nearly half the S&P 500 has lagged.
Sure. So look, since the low, the S&P equal weighted has outperformed the cap weighted. That makes total sense to me because as people slowly capitulate into the market, they're looking for things that they can feel comfortable buying because they don't like to buy the all-time high list. And I think, Bonnie, what's really important to understand here is that unfortunately, investors sell for the first year off a bear market low. They always do. It happened in 2020. Flows didn't turn positive until a year later. Likewise, we had a low in this bear market in October of 2022. Flows only turned positive in November of this year. And so when the flows turn positive, people look around for things to buy, and voila, it's a lot of those stocks that are equal weighted that have very much lag. So I think when that happens, it tends to continue. And I do think that the equal weighted will outperform the cap weighted next year. But I am intrigued. I got to tell you that is a very consensus trade. And I hear very few people saying, well, some of these mega cap stocks, they might continue to power higher. So I am intrigued by that because they have lagged recently.
Well, how do you think then about price to earnings ratios at this point? Because you look at just how expensive, for example, the NASDAQ 100 is relative to history, and you wonder how you start to recalibrate valuation in yet another interest rate paradigm potentially into next year.
Yeah, sure. It's a great question, Sonali. So look, two things I would say that. Number one is I am a huge believer in psychology of finance, psychology of investing, because that's the consistency. So when I talk about investors are only coming back in the market, that's a psychology conversation. Predicting GDP, predicting interest rates, predicting earnings, look at the errors the supposed experts made at that this year. And now, what has that got to do with your question? Well, the reality is that if you look at the earnings estimates for those very large cap stocks at the beginning of the year, you would have assumed they were expensive. But that's because the E that was predicted by Wall Street was very, very wrong. These companies ended up producing much better earnings than what was expected. So always be very wary of a stock is cheap or expensive based on a PE, because sometimes it's because the E is wrong. Whose E is that? How good are they at predicting earnings? And for these mega cap stocks, their earnings estimates have been raised by over 10% this year. So I'm a little bit wary of, gee, these stocks are expensive, they're cheap. I'm more interested in earnings trends. I understand there's a lot of equal weighted stocks, financials, industrials that had very good revisions this year and have lagged. So I am intrigued by that, but purely looking at valuation as a methodology to investing, I think is very faulty. It would have put you in Europe over the U.S. years ago, and we know how that's worked out.
Speaking of the E in the picture here, it's just weeks after the new year turns. You do get that earnings season once again. Do you think there's more risk to the upside or downside at this point?
What my sense from listening to third quarter calls and since that juncture is that companies probably will not come out into the their fourth quarter earnings estimates and downplay the full year. I think right now, as we sit, 242 to 245 is on the table, and I don't expect that to materially weaken. And that's all we really need at this juncture, because that's a 12% earnings growth for next year. But the real question is the market looks forward. So the market is already pricing that 245 next year. But let me remind you that right now the estimate for 2025 is 275. And that, if you fast forward to the end of the year, that's how you get more upside in the market if, in fact, that number happens. So all through this year, I was very focused on, is the likelihood we're going to end 2023 with $242 to $245 for next year. That's what's important. Now we're going to transition to how likely is 275. And you can tell me I'm crazy. No way it's going to happen. And believe me, many people told me this year that there's no way 242 was on the table, but the reality is companies never brought down their numbers enough to bring that number down. So we'll have to watch. That's a key metric I'll be very much paying attention to as we move into next year.
So, Andrew, you also point out that every year that it's a presidential election year, that the incumbent is running again, we've seen the stock market go higher, and that's 16 times now since 1940. How much will next year's election roil the stock market, before it actually hits a record, as you expect, I imagine?
It's an amazing statistic, right? The last time a president ran for re-election, didn't necessarily win, just ran, and the market wasn't up, was 1940, and that was just as World War II was breaking out. Every year afterwards that the president has run for re-election, the market has been up. It's an average return of 16%. Why is that? Well, it's because presidents want the economy humming into an election year, and I think Joe Biden has enough mandates from a fiscal spending, whether it's the Infrastructure Act, Inflation Reduction Act, or the CHIPS Act, all of which have already been approved by Congress. He can pull those levers, and I think that is why markets tend to go up in election years.
There's so much conversation about the upside here and the excitement on all the green we're seeing on the screen. But what throws off this rally here, Andrew? We're talking about how far things could turn.
Here's the downside. The downside is historically when the Fed cuts rates, the market gets anxious and the market has a pullback. Because even if Jerome Powell gets up there and says we're cutting rates because inflation's over, there will be enough people that will come out and say they know something we don't. There's they know they're worried about something, and it creates concern in the market, and you tend to get corrections at that juncture. Even if there is no economic concern, the first reaction by the market is a pullback. So I suspect when that happens, and I don't think it will happen as soon as the markets think, but when that happens, I think we'll get a pullback in the market because it will create some anxiety that maybe there's danger lurking out there. I don't think there is, but it will create that anxiety.
Always possible dangers. Our thanks to Andrew Sliman of Morgan Stanley. We appreciate your time, and very happy New Year to you. Now, still ahead, we're going to be joined by My Teresa CEO Michael Klieger on his insights on holiday spending trends in the luxury market next. It's an interesting part of the market, Vani, because we know that retail is complicated in this day and age. And we're going to talk about how that's holding up on the higher end and whether that can continue into what people believe will remain a strong economy, even into a hard or soft landing. That's up next. This is Bloomberg.
back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
This is Bloomberg Markets. I'm Shonali Bassick alongside Bonnie Quinn on another green day in the markets.
Exactly. For most markets anyway, Shonali, we are not quite at a record yet for the S&P 500, but we're very close, just a few points, so we will be keeping an eye on that. Of course, we don't really care about records, do we? We just care about,
Yes, we do. We have money on the line on this one for you and me.
Yeah, but if it makes a fresh high, or if it ends the year off that high, it's not that massive of a deal. We are seeing a little bit of profit-taking potentially in the Treasury market, but also that 7-year auction that was just a little bit disappointing, especially given that we had other auctions this week that cheered investors. So we're seeing the 10-year yield at 385.36, still below actually where we started the year. A little bit of give back for Bitcoin, above $42,500 a coin though. And then we are seeing definitely now more punch come out of the oil market with crude in New York trading just about $71 a barrel, in fact.
Yeah, it's interesting to see that move downward in crude and in Bitcoin. I want to talk about those records a little bit here because we talk about the S&P, that's where the excitement is, but also the other indices that have hit records. They're not trading at session highs today still, but we are watching the stocks still slightly green on the day. The NASDAQ 100 at its highest level since the dot-com bubble, which invokes a very significant feeling about that particular record high reached earlier today. The NASDAQ composite still up almost 0.2% on the day, and the Dow Jones also hitting a record earlier today, up almost 0.3% on the day. Now, we're going to switch gears here and talk about Cathie Wood because one of her funds executed a massive shakeup to its Bitcoin-related holdings. It sold off its remaining position in the Grayscale Bitcoin Trust because of uncertainty about whether it will successfully be able to convert into an ETF. Still, the ARK Invest CIO and CEO joined Bloomberg TV earlier today to say she's still bullish about the cryptocurrency. Take a listen.
We're as optimistic about Bitcoin as we ever have been, but there are a few regulatory and tax uncertainties, and we had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally. And now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk.
And I mean, let's get a little bit specific here because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BIDO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BIDO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
That was ARK Invest CIO and CEO Kathy Wood. Now we're going to switch gears and take a look at the luxury e-commerce market with Michael Klieger, CEO of MyTheresa, who joins us now. It's an interesting time to talk about luxury and retail, and you've had a long history when you think about the retail market more generally. Michael, how does your market, the higher end of consumer here, compare with what we're seeing across the broader American economy?
Thanks for having me. I mean, for sure, the luxury market and the luxury consumer shows higher resilience to significant geopolitical news or economic news, and therefore we have seen a good development in luxury spend online. There is clearly a two-tier market. There are these consumers which we call the aspirational luxury consumers. They have held back on spending, and that trend has taken place over the last 12 months. And then there are these big wardrobe building spenders, and they continue to spend, they continue to invest in pieces. Price points are not really an issue for them. And so with this tale of two customer segments, the higher end is spending and continues to spend.
How much does that start to hold up, though? I mean, at what point do you see the higher end of the consumer start to break a little more? What would it take?
Well, I mean, obviously, the wealth of these consumers are tied to the stock market, are tied to commodity prices, are tied to real estate markets. And so even though in some of these sectors we have seen uncertainty overall, just looking at the indices today, these numbers are pretty good, and therefore the wealth for our consumers and those consumers is in good shape. And so if something would happen there, then of course they may also be impacted. But unemployment rates, inflation rates are far less of a concern to these big spenders than, of course, for the overall consumer population.
Michael, what stopped working with online retailers? So we had Farfetch selling to South Korea's Coupang just recently. It was facing administration before that, where it was a darling just a couple of years ago. Matches Fashion in trouble. Yoox Net-a-Porter not doing so well. Essence laying off staff. List. Even The Real. What's wrong with this segment?
Excellent question. It comes back to the two consumer segments I alluded to. There are luxury spenders, we call them aspirational consumers, that are keen to buy one or two pieces. The iconic bag, the iconic pair of sneakers, but they usually tend to spend one or twice a year, particularly around the holiday season. And then there are the big spenders, the continuous spender. They lead a luxury lifestyle, and those continue to spend. And our focus has always been to serve these big spenders. So in our last quarter, which is our first quarter in the fiscal year, July to September, we grew net sales in the US 28%. We grew our top customer base by 56%. So quite in contrast to the general even luxury online pattern, and that's only due to a different customer segment that we focus on.
But then why are you guiding to the low end of expectations and everything? And why isn't this business more profitable? And why is the stock down so much this year?
Well, to the first part of your question, we are guiding for growth this year, for our fiscal year. We are guiding for profitability, and very unusual profile to any one of those companies you mentioned. So we are clearly outperforming the sector. The sector is under stress on the aspirational consumer side, and that has led to quite intense promotional activities of players that found themselves with too much stock in the market. But again, merchandise stock, I mean. But again, we are guiding for growth. We are guiding for profitability for the full fiscal year, even though to the lower end of our guidance. So we see ourselves as clearly the winner in the market, and we clearly see ourselves as outperforming. On the share price, yes, our share price has not reflected our performance. We do see that investors are trying to figure out what is happening in the luxury sector. Is it as resilient as they expected? And of course, trying to understand the difference between players that had focused on this aspirational consumer versus players that like us, but also like some of the big luxury brands that are always focused on the big spenders.
Speaking of the big spenders, you had mentioned promotional activity. It seems like the age of inflation really has impacted everybody across the board. How much longer do you think that the promotional activity will stay strong, and how steep are the markdowns on average?
The promotional activities are clearly linked to the fact that too much stock is in the market. And the specifics of luxury is that there are tremendous lead times. So we are currently at the end of fall/winter 23 season. This is merchandise that has been bought last year in November, October, December. So this was bought, and there's still no understanding how weak the market on the aspirational side would be. With spring/summer 24, which is the next season starting, it already has started, but the peak will be in March, April. We will have much less stock in the market because this was bought in March, April, May of this year with a clear view on the slowdown. And with much less stock in the market, we expect a far more disciplined approach to markdowns and the far reduced promotional intensity in the market.
Michael, we're very, very concerned with the Chinese consumer right now as well, because obviously China can be a very, interesting leading indicator for the United States and economic activity. What insights can you give us on the Chinese consumer?
Well, the Chinese consumer spend has followed a completely different pattern from Western Europe. Remember, the pandemic really did not impact Asia, and particularly mainland China, until autumn of last year. Only autumn of last year, when the official policy towards Corona changed towards COVID, there were massive infection rates and massive lockdowns. And the Chinese consumer coming out of this phase in January, February of this year, there was an expectation of a quick rebound, of a sharp rebound, and that has not happened on a broad scale of consumer spend. It had happened on hospitality. It has happened on travel. Numbers are up, so the sector is improving, but the sharp rebound back to levels before the pandemic hit last autumn did not happen, and it's a slow return at the moment.
Fascinating. Michael, thank you so much for your insights today, coming to us all the way from Munich, Germany. That is Michael Klieger. He is CEO of My Theresa. The L'Oreal heiress has become the first woman to reach a fortune of $100 billion. Congratulations to Françoise Bettencourt-Meyers. Her wealth jumped today after shares of the beauty products company hit a record. And I'm finding it fascinating, Shonali, that it is French beauty companies that see the biggest and wealthiest people in the world for the most part. I mean, she is eclipsed by Bernard Arnault, who owns, all of the great brands, including Chanel and so on at LVMH. But this is a serious milestone for a woman. She's a recluse, she's 70, and she's now a 100 billionaire.
Yeah, it's kind of amazing to your point here. French beauty and fashion, the Hermès company and family behind it as well, has had intense competition. And she is still far behind those families. However, to your point, a massive move here. We're seeing more women across the world become billionaires based on not only their family enterprises here, but really focusing on a market here that, and just L'Oreal alone is expected by Consumer Edge to rise another 12% over the next year with resilience of its products across different geographies across the world. So, of course, not just France or the United States. So opportunity there, even if she's lagging behind, and a new milestone for her, certainly.
And I love when we do these stories where a woman hits a milestone, right? It's Taylor Swift one day, it might be a lot less than this, it's $1 billion, but it's also now, a French woman who's also hitting this milestone, owning 35% of the company, and it started as a hair dye company. Did you know that?
I did not know that. And as you know, I'm going to start doing that myself very soon.
You don't need to for one gray hair. Are you kidding me? She plays the piano for hours a day. She likes to keep to herself.
Oh, that's fascinating.
All right, well, coming up, we're going to hear from Scott Bach, chairman at Greenhill and former chair at the University of Pennsylvania, about the recent crises at some of America's leading universities. That's coming up right here on Bloomberg Television, and for our listening audience on Bloomberg Radio, this is Bloomberg.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Markets. I'm Vonnie Quinn along with Shonali Basak. It's time now for our Wall Street Week daily segment. Scott Bach, chairman at Greenhill and former chair at the University of Pennsylvania, spoke with Bloomberg's David Weston about how universities are responding to the backlash they've received regarding anti-Semitism.
We've had a bit of a crisis on some of the leading elite universities in America in the last few months, and we haven't had one in a long time. It's really been a long period of quiet and progress at those schools, and so there are a number of questions that have been raised that haven't been raised in quite a while.
And what about the response to it? Are people a little rusty? I mean, I went to school back in the 70s when there was a lot of this going on. And in fact, administrations were used to dealing with demonstrations. Is part of the issue that, in fact, the administrations haven't been used to this? They sort of have to get the rule book back out.
I think that's exactly right. And frankly, trustees haven't given governance a thought in a very long period of time. You don't tend to think about governance when everything's going great, but when you have something that creates a controversy, suddenly people look back at that. And I think a lot of trustees, maybe have forgotten that the way universities are governed, that it's a combination of trustees, a president and the administration, and also the faculty play an important role.
Well, we'll talk about that for a minute, about governance specifically, because we've had, for example, at Penn, but also at Harvard and other places, donors really speak out very forcefully, even make demands, as they would put it, about changes to be made. Back when I was practicing law, I know you did as well, we used to talk about a bad volleyball team where everybody goes to the same position. What are the respective positions, if it's done properly, of the trustees, the president administration, the faculty, and for that matter, donors? What should those positions be?
Look, I think to start with donors, I think donors are absolutely free to give to whatever organizations they want or not to, and to withhold for any reason they choose to, but they're not shareholders, so I don't think they should have a particularly loud voice in how a university is run. There is a governance system that's been in place for decades, if not centuries, in many cases, and that involves really trustees, the administration, and the faculty. Historically, trustees really focused on the financial viability of the organization. They did the budget. They reviewed the audit of the financials. They invested the endowment. They made sure that the entity was going to be viable for the long term, because these are meant to be perpetual institutions, of course. The president and the administration really run the business of the university day to day, and along with the faculty, they run all the academic affairs. And it's really been very rare, in my experience, really almost 2 decades, on a board of a university where the trustees get it all involved in academics. So I think they need to be careful about how much they reach into that area, and I know faculty are very concerned that they not reach too far into that area.
You mentioned 2 areas, academics on the one hand, finances on the other. Obviously, you're a prime example of somebody who's really, really knowledgeable in finance. It would make sense to have you on a board, and indeed chair of a board. There is a third area, though, which I would call reputational risk. I mean, existential risk for the institution that maybe includes both academics and finances. But who should be responsible for that, and what sort of people do you need at the table making those decisions?
Well, I think clearly if it's an existential sort of threat, I mean, everybody needs to be involved in that. I don't think trustees can sort of seize control, nor can the president do whatever the president wants to do, or the faculty take charge either. It probably needs to be everybody involved in something like that. But I don't think trustees should overreact in the situation of what could be a short-term crisis and take too much control. It still needs to be a collaborative effort, because that is the peculiar nature of governance in these institutions. They're not public companies, and they really aren't run by like public companies historically.
By the way, there's another player that's gotten involved here, and that's the United States Congress, because the president of Pennsylvania, as well as Harvard and MIT, were called before Congress. What, if anything, is the proper role of the government in trying to influence the way this is handled on college campuses?
Well, I think the government has a very big role, of course, in public universities and a smaller role in private universities. But, you know, governments get involved in a lot of ways in any institution in American life. So you have to be ready to deal with congressional or other government inquiries when they come. And they do provide financial support to even the most private of universities in the sense of research funding and things like that. So they're going to have their legitimate questions from time to time, and those need to be answered. But fundamentally, the institutions we're talking about are private, and they're run fundamentally by the trustees, the administration of the university, and the faculty. And that's worked for a long time. I mean, I think it's important to remember, you know, elite universities in America are the envy of the world. I mean, people all over America go to great lengths to get into these places. People from all over the world do. You don't see a lot of, you know, kids from New York City trying to go to a foreign university to get their degree. You see a lot of them in Europe and Asia, Latin America, elsewhere, trying to come to America to get a degree because they see real value to that.
When problems develop in any large institution, that's corporations as well as colleges, I always ask myself, is it a substantive problem or is it a communications problem? And often it's a combination of the two. As you look back at what's happened at Penn, at Harvard, at MIT, how much of this is really a substantive underlying question of values and what the rules are, as opposed to not being clear enough on exactly where everybody is and what the rules should be?
I think it's probably a fairly substantive issue. I mean, communications is always a part of these things as well, but I think it's a fairly substantive issue. And I think the biggest factor, the biggest challenge really has been that we haven't had any sort of a crisis or controversy in quite a long time. I mean, you referred earlier to the 1960s. That's a long time ago, well before I went to school or you went to school. But, you know, there was a lot of unrest on campuses back then. And frankly, since then, it's been relatively quiet. I mean, there have not been that many controversies. There have not been that many moments when trustees asked about governance or what their role should be. There have not been many moments when I think faculty felt threatened by trustees and what role, or donors, and what role they might like to play. And so when something suddenly comes along, everybody doesn't remember their role anymore because they haven't thought about their role in quite a while. Things just kind of hummed along quite nicely.
In the 1960s and into the 70s, part of what we saw on college campuses was a reflection more broadly of what's going on in society. I wonder if that's part of what we're seeing now, because generally across our society, there is more polarization. People are more outspoken. They're more actually coarse with one another in the nature of the discourse. And if that's right, what can campuses do, what can colleges do, maybe to help us more broadly in society deal with some of these issues?
Look, I think that's a major factor here. We are in a more divided society, and the divisions tend to be quite deep, and people tend to see things in a black or white way. There's a lot of, and the voices you hear are on the extremes, right? You're the extreme right, the extreme left. I do think it's important, and I've tried to convey in some of the comments I've made in recent days and weeks that, what you see on social media, what you see maybe in a newspaper quote, what you see in a clip on television is a very small part of what actually happens on campus. I mean, as with anything else in life, the noisiest people get the most attention, right? So it's a small fraction of 1% of the people at these elite schools that are really actively involved in a way that anybody would find troubling. 99% of those students are going about their business, trying to get a degree, trying to get into law school or med school or get a job at Goldman Sachs or Teach for America, and they're really not that involved in this. But yet you can get a sense from the outside, particularly if you're looking at Instagram or Facebook or just reading the tabloids or something, you're going to get a different view about what's happening on these campuses.
Scott, clearly you've thought through these issues a lot. You've been on the inside looking at them. You have a lot of very reasonable sounding thoughts about what should be done, what should not be done. Why'd you step down? Because you could still contribute to the solution, could you not?
I could certainly. I mean, I felt like our board got particularly divided at one point, and I felt like clearly there is a debate, and it's not just at Penn, it's a number of schools across America about the role of trustees, faculty, and administration in managing universities. I think that's a very important debate, and frankly, I felt like I could contribute more to that debate from the outside than the inside. If you're the chair of an institution that has, in our case, almost 50 trustees, you have to speak for that whole group. You have to be very, very careful what you say because you're speaking for the whole entity, a whole large group of trustees. If you're on the outside, you can speak more freely. And I think I have contributed, and hopefully even these comments here will help people understand that there's not a huge crisis. It's a small percent, very, very small percent of the students that are doing things that would be troubling for most people. Yes, there are things you can do about that, but we shouldn't fundamentally tear up, a governance model that's worked for a very, very long time and made our universities the envy of the world because of a very short-term crisis.
That was Scott Bach, chairman at Greenhill, and Bloomberg's David Weston. You can watch more Wall Street Week Fridays at 6 p.m. Eastern Time. Now, coming up in the next hour, we're going to talk with Lisa Lippman of Brown Harris Stevens on her insight on the market for luxury Manhattan real estate. It has certainly, Vonnie, been an interesting market for luxury real estate, while the broader market has really struggled.
Exactly. We're going to get some great statistics on what actually was sold in New York City, because obviously, when you're talking about real estate, you have to talk about Manhattan for the most part, but also just